Good morning, everybody. My name is Jay Martin, and I am the CEO of Cambridge House. If you're a subscriber, welcome back. If you're new, welcome. Click subscribe. I'd love to have you join the tribe where every week I produce several interviews with the smartest people I can get in touch with in the finance sector with a strict focus on speculative investment. In addition, I've spent the last decade building some of the largest investment conferences all over the world, and very soon I hope to be doing so again. But today, what we are doing is diving deep into the copper sector because copper has become one of the dominant headlines in the resource sector. And whenever this occurs, sentiment gets ultra bullish, the price hits all-time highs, and the noise increases. And it becomes very difficult for investors to cut through the garbage and find the quality. That is what we endeavor to do today. So I will be joined by some of the smartest people when it comes to copper, namely Warren Irwin, the founder of Rosseau Asset Management, one of the pioneers when it comes to investing in the resource business. I'll be joined by Rick Rule, an absolute legend, no stranger on this channel. Most of us know Rick as the face of Sprott Asset Management, but Rick has recently departed this role, and now he's just a very wealthy private investor who can say whatever he likes, no more need to filter himself. And he doesn't. So pleasure catching up with Rick and getting a sense of where he sees opportunity in the copper space. I'm also joined by Tavi Costa, who I've only had on the show once before, but Tavi's fascinating. He's a crowd favorite. He's a portfolio manager at Crescat Capital. And Jamie Keech, the founder of Resource Insider, partner at Inventa Capital, and one of the individuals in this business who writes a check before he says anything. And Jamie speaks and acts with his wallet. I appreciate his transparency, and he lets us in behind the kimono today and tells us where he's put cash and where he's planning to put cash, which I always appreciate. I will also be joined by a small handful of early stage speculative investment opportunities, because that is what I do all of this for. So thanks for coming. I hope you enjoy this. Drop me a comment. Let me know what you think. I'll be in the live chat engaging. So say hi. And if you love this, please hit subscribe. I'd love to see you again. Thanks so much. What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined once again by Tavi Costa, portfolio manager at Crescat Capital. Tavi, how are you?
I'm great, Jay. Thanks for having me again.
No, I'm excited to have you back and pick your brain on a bucket full of topics. Last we spoke was January. So yeah, right at the beginning of 2021, and lots has changed. The year kind of started, well, it started pretty sleepy in the commodity space, and that's now looking like it's changing. I shouldn't say sleepy in the commodity space, but a bit sleepy in the gold sector. So anyways, where I want to start with you is you and your partner, Crescat, have been talking about the change in sentiment, and I guess the change from growth stocks to value stocks, right? The change from financial assets to hard assets. And I've heard you refer to this as the great rotation. So if we could start there, Tavi, at a high level, what is the great rotation? What's occurring right now in the market?
Well, it involves our views about inflation as well. And I think when cost of capital begins to rise for whatever reason, labor cost or inflationary pressure, you begin to move away from high flying multiple names such as tech companies, and capital starts to flow into especially tangible assets in general. And so when you have a situation where it's very difficult to find anything that has yield, S&P 500 earnings yield is actually below inflation today. Corporate bond yields do the same. You look at the treasury market, it's difficult to justify buying that as well, given where we are, again, with relative to even bogus CPI or any other inflationary gauge. And so the difficulty of finding yield and the scarcity of assets that can offer anything either above inflation or above zero is forcing folks to look for tangible assets. And that begins to drive natural resource stocks. And that's why I think most of those are part of the the value names, and that rotation that we're seeing has a lot to do with that. And it has a lot to do with the commodities to equity ratio, which is at a fresh 50-year low, or it was before this run up in commodities. But when you looked at commodities relative to equities, it's still incredibly cheap. And so this is just the beginning of a bigger move, in my view. And at a time when, I think investors are beginning to realize that there's not a real case, a bullish case for equities, especially the tech names and the ones that have very strong or very high valuations. And so, what is the bullish narrative here? We're talking about, we went from yield curve control to now talk about tapering in a matter of a few weeks. That's not bullish. And so, or if we go back to the talks of doing more money printing, then we're going to just reinforce the inflationary issues that we're seeing. And so that's also not very bullish. We've had 2 decades in the past century or so of inflationary forces going above 6% on a median basis year over year. And that was the 1910s and the 1970s, not the 1940s. That was not at all, actually. That had some sporadic increases in inflation, but it was well below the entire decade of median CPI. And so it's not a good decade to look at in terms of how assets really behave. And the 1910s and 1970s, you saw, first of all, commodities doing very well. In the equity market in general, if you look at just the S&P or the Dow Jones, which was the data available since the 1910s, what you find is that the equity market was barely up, was up about 1% in annualized terms. And when you consider inflationary forces, you got real negative returns in those decades. So I think there's a lot of misunderstanding of how equities may react. And then again, we're seeing an improvement in the economy. Remember the disconnect that we saw in 2020 of financial markets doing incredibly well, but the economy doing very poorly. And now we're seeing the opposite, where the economy is doing better and the markets are not doing so well. I think that's probably going to continue again. And that's a product of stagflationary environment. So I think that's where we are in right now.
And so thank you for that. And do you see investors' sentiment shifting, as in becoming more risk averse? And those names that you mentioned, a lot of the tech names, the historic growth stocks over the last decade, I mean, not only are they hitting all-time highs, valuations are crazy, but also are you seeing a trend of investors looking for companies that are actually generating profits today more so than they were a couple of years ago?
That's, I think the sentiment is starting to change. I think folks are beginning to realize the value proposition in value stocks. And starting to find that a lot of natural resource companies have not only the value proposition, but also a lot of embedded growth in terms of the factors of free cash flow and revenues and margins. Everything is improving significantly relative to the tech names. I've shown the chart before, free cash flow yield, for instance, between gold stocks and tech companies. And for the first time in 30 years, gold stocks look more attractive on a free cash flow yield basis than tech companies. And so the party hasn't even started yet. Gold is, in my view, very undervalued relative to a lot of things, such as the monetary base and money supply, the equity markets, and what we're seeing in terms of policies. And so certainly things are changing. And when you have this environment where cost of capital begins to rise, and you start to see things like profitability becoming a priority. And so quantitative or fundamental factors are also cyclical, and they change over time how investors tend to rely on different things. The last decade or so, growth was certainly, especially the top line growth and not making money, was certainly the priority for investors, and how a lot of companies have done so well. You name it, from Netflix would be a great example to Uber and other names that have done so well, especially in the tech space. And then some of them became profitable. That's fine. Amazon is a great example of that. But the majority of them actually are not extremely profitable relative, especially with the valuations don't justify the investment in those places. Unless you have a deflationary environment, then certainly makes sense. Now, what we're seeing here is a change where cost of capital is beginning to rise. Regardless, we can talk about why. I think there's three pillars into that are very important that are going on right now. And as we see that changing, I think folks are going to start looking at bottom line improvements a lot more and giving that as a relevance, especially for quant models and just fundamental analysis in general. So the in-depth analysis of looking at annual and quarterly reports is back, and I think that's going to be a big change. And some investors are not. You asked about sentiment. Yes, that has started to change. Some folks are beginning to realize at least the opportunity on commodities, but most of them are focused on the supply bottlenecks, which I think was certainly something we were talking about in our last interview regarding the similarities with the 1919, the Spanish flu environment that we saw back then, and using that as a roadmap for what's happening today. But there are a few other things that may come out from this that happened back then that I think will also change and kind of shape this investing landscape. And may cause some changes on how we look, especially and give more relevance to profitability.
I want to jump into those three pillars, if we can, and in a couple of comments you made about investors moving towards companies generating free cash flow, and I think you tweeted relatively recently something like 73% of miners right now are generating positive free cash flow. The significance of that number is that that's higher than it's ever been in my career in this business, right? Significant.
Yes, and I just want to point out that that's for the top 50 miners. As we all know, there's a very large universe of companies that still don't make any money, and a lot of small market cap companies that are trying to find discoveries all over the world that don't have free cash flow. But when you look at the top miners, then most of them are actually now profitable on a free cash flow basis. If I could answer the question about the three pillars of inflation, which I think it's so relevant for what's going on right now, it starts with the demand side. What we're seeing in terms of savings that shot up to $6 trillion or so back in March and April of 2020, unleashed somewhere close to $3.6 trillion of consumer spending, which when you look at that in a historical average basis, about 7.5 times higher than any other time on an annual basis in history since the 1960s, inflation adjusted. Okay, so right now, why is this relevant? Is because we just shot up again to $6 trillion with the recent fiscal spending that we in the helicopter money policies of giving money to the population. This is going to unleash a massive amount of consumer spending again. And so it's difficult for me to see a deflationary environment with such a strong pillar of inflation moving towards that direction. And I don't think the supply chains are actually ready for that again. Why? Let's talk about the second pillar. That's the cost push one, which is divided in two parts. One of them is the supply issue, which we discussed very in depth in our last interview, which again goes back to the 1919 Spanish flu environment, when we had not only it wasn't really aggregate demand that was driving consumer prices higher. It was constraints in the supply side of things, and so. Again, we're seeing this one more time in another pandemic situation. And what comes out after that, which I think is what matters, right? If we call it, well, what happened in the last few months, let's now talk about the following months. I think we're at the early stages of an upsurge in labor management conflict, which will cause, in my view, labor costs to rise. We're starting to see that some of those companies, more popular companies such as the McDonald's of the world or Chipotle and some other restaurants, are beginning to be forced to raise labor costs in order to bring people back to work. And one thing we didn't see in 1919 was the fiscal policies were not really discouraging folks to go back to the labor markets. This time around, we're certainly seeing that. And funny enough, the policies that are trying to answer and trying to improve the recovery process are actually the policies that are also making things a lot worse. And so the third pillar of inflation that is also becoming an important part is the monetary debasement issue. This framework that we've solved so far, especially from investors to try to justify what the Federal Reserve is doing. In other words, the dual mandate of maximum employment with also stable inflation. Look, that's over. I mean, that's not what the Federal Reserve is doing. That's very clear. I mean, if you do any macro data analysis, you know that there's no way they're justifying, unemployment or labor market issues and inflationary forces being low in order to justify the quantitative easing and the near zero, interest rate policy that we're seeing right now. It all comes back to suppressing interest rates and allowing the government to do the fiscal spending that we saw so far, and having to have the interest rates low in order to allow the government to have debt to GDP at 140+%, as we saw, largest level in history, and also valuations. The Federal Reserve knows that a 10-year yield of 4% or so would never be a good factor for the equity markets at record valuations. And so those are the issues right now. And the way they deliver the message right now is with this dual mandate, which has been the case, and it's becoming more and more of a broken record when you listen to them, not concerned about inflation just yet, is looking at their CPI bogus number, which I don't like to say that usually, but I don't think CPI is really representing at all what's going on in the system, especially their own CPI. When you look at median CPI from the Federal Reserve, it's at a 7-year low. So when you combine all those factors and the three pillars of inflation, I think it's very difficult to see that turning around. And I think there is a big chance that we may be triggering a long-term inflationary problem. And if we're entering that environment, I think you have to invest accordingly. And in this case, commodities look very interesting still. Some of them had a big run, and I prefer looking for others that still look incredibly attractive relative to others. But look, I think that the whole space is going higher, and that great rotation situation I was referring to will continue to occur, in my opinion. And it's going to change how money managers do following, especially different approaches, such as a value approach, maybe is starting to get in favor rather than out of favor, as we've seen so far. And so those are the big changes right now.
Okay. Now we got to talk about the renewable energy trend a little bit. And, a statement that's come up on my channel a handful of times, and I've seen it make it headlines otherwise, is that copper is the new oil. And I think it's an imperfect statement. I like the way Irwin responds to that, saying copper isn't the new oil, copper is the new pipeline, which makes a bit more sense to me. But Tavi, the macro trends driving copper demand are reflected in the copper price surging to all-time highs. But the copper miners are where there's some awesome opportunity, and the explorers. Are you guys at Crescat deploying capital? Have you been deploying capital into the copper space?
It's always been more complementary because of our views about looking for more monetary metals, and especially the ones that can really benefit from a monetary debasement environment, such as gold and silver. However, I'd rather be long copper than be long NASDAQ. And so the cyclicality of copper is something that concerns me a bit, given where we are in the business cycle and this still euphoric environment in general that we're seeing in terms of investment sentiment out there. But I was discussing a lot of this with some of the large gold and silver miners. This is maybe a year ago or so, and asking questions about copper. I remember that so well. None of them wanted to really increase their, was really attracted to the idea of increasing exposure to copper. I thought that was interesting that now they're changing their opinion, and it seems like prices change people's opinions. It should be the other way around. You should be looking at the factors to see if prices will be impacted by that. The relative, I guess, analysis between copper and oil is interesting. I think copper has more long-standing, especially demand factors for going forward. However, oil does have a high probability, in my opinion, of going well above $100 a barrel in the following months, given not only the supply issues, but this consumer demand that we're seeing in places, especially like New York, with traffic coming back, not because people are going back to the office as much, but really because no one wants to take public transportation right now, and so a lot of people are driving instead. And so those will have an impact on oil in a kind of a shorter period of time. We're certainly trying to move away from oil, which creates an incredible opportunity for oil in the short term and medium term. The long term, and I think copper looks much more attractive. We've had a very big run recently, and some other base metals I think may look a little bit more attractive than copper, just because of the run up recently. And when I keep thinking about this cyclical, the green agenda, something that fits that environment with the supply constraints, that also serves as a monetary metal, I go back to silver immediately. I think that's the cheapest metal on earth. I've said this before. I think it's going to go a lot higher. But I like copper, and again, I prefer. I like to say this. I'd rather be long copper than NASDAQ. I think there's a lot more things going for copper than the NASDAQ itself. The entire base metals industry is about $1 trillion in market cap in aggregate. They're producing somewhere close to $18-20 billion of free cash flow. And so there's, this is using numbers from December. We had a run up in base metals. I really want to see where we're going to be in terms of growth of free cash flow in that environment. I'm seeing a lot more growth in the gold and silver space. But again, I think that this entire commodity space looks attractive regardless. I'd much rather buy that those companies that are actually producing free cash flow than other software companies that only have top line growth with no earnings, no free cash flow, and massive multiples that are not justified by the current macro environment.
Got it. Okay. Now, I'm getting a couple questions via Twitter here for you, Tavi. The first one is, what's your commodities exit strategy? What leading indicators would you look for to know we're nearing a top and it's time to start de-risking?
Well, I think those ratios I referred to, such as the commodities to equity ratio, gold, silver, copper relative to money supply, when you start seeing those peaking, I think that's the time to be getting out of that. And honestly, I think there are some folks like to be invested in tangible assets during their entire investing career. That's not so much my case. I think this is much more of a macro setup that we have that may last 5 to 10 years, depending on the commodity. And so I much rather build a business around this opportunity and really try to implement this as best as possible. As of now, in terms of the way we're implementing and the prices that we're being able to buy in terms of securities in general in the space, we're nowhere close to the peak of this, especially in the precious metal space where things are just incredibly cheap still. The copper space too, we've had a few stories, luckily or not, that turn out to be more copper stories than precious metals than we thought. And with copper prices where they are, I guess that's not a bad thing. And so our exposure to copper actually increased given the price of copper rising, and also the development of some of those discoveries that we've had. I'm going to try. Answering your question really is once we've got with this development of inflation, done, then I think it's time to move on to back to equities and look for what's the new sectors of the economy that we should be focused on. I don't think that's the case at all today, and not what I'm focused on. We haven't even started the M&A phase. in this space. I mean, just like I had a discussion a few months or maybe a year ago with some major companies in the gold space, and I'm talking about real majors. And there were no interests back then in terms of buying copper projects, and now seems like there is some more. It's interesting that we asked the same question recently regarding some of the new discoveries that we've had in our portfolio and offering them the idea of co-investing in some of those. And their answer was pretty simple, was that we cannot do that right now. We have to explain every cent in our income statement and cash flow statements. And we would never be able to really justify an acquisition at this moment of a project that is not profitable, of a project is just perhaps a good hope of a good discovery. And so, we know that changes over time. If they want to, if we're right and they're going to be probably paying up for those projects down the line, I think that's what's going to happen. Those usually, unfortunately, a lot of those management teams tend to make those decisions the wrong way. They're not macro investors, and so I think that's what's going to happen. We haven't even seen the beginning of that yet, and so I'm very bullish in the whole space. And it's really, we don't know when gold, silver, even copper, will continue to probably move a lot higher, but we don't know when the even bigger move may happen. And so it's important to be positioned and continue to look for really good risk reward opportunities in the space.
Okay, I love it. Just given the time, I'm not surprised that this question is asked a few times. What are your views on Bitcoin, Tavi?
Well, that's a good question. I've always sympathized with the thesis, and I always liked the community in general that is more the awareness of the monetary debasement issue that we're seeing for so many years, but certainly has been magnified in the last year or so. And again, just like copper, deserves to be at higher levels relative to NASDAQ. I also, and I'm comparing the two because of the cyclicality. I also think that Bitcoin deserved to be better, to be at higher prices relative to a lot of the tech names. As of today, I think we've seen so far, especially this year, a lot of frothiness in the space. I think the crypto market looks a lot like the internet market, where a lot of, we don't know yet who are going to be the winners and losers. And I think in a few, there's no rush to be in the space, in my opinion. There seems to be all this rush from a lot of people, and I think it's a bit ridiculous. That's just my opinion. I think the rush for me is on something that is more less on favor, I would say, especially monetary metals and things like that could become, a bubble at some point. I'm much more interested in doing that, where not a lot of folks are interested and very skeptical. The Bitcoin trade seems a kind of like a consensus trade in 2021, just like back in August in 2020. I think gold was a consensus trade as well. And so it needed a pullback, a recharging period in order to correct and then perhaps move a lot higher. And I think that's what we're seeing. We're still in the secular bull market for that. I think there's going to be a lot of interesting developments. Obviously, there's a lot of smart folks getting into the crypto space from smart places, and I know some of them. And I don't think they obviously will build something that will be very useful, just like the internet was for us in the early 20s all the way to now. And so, I just think there's no rush to be involved in the space, especially given where we are. I find it interesting that we saw MicroStrategy really peaking way before Bitcoin. And it's just a levered play on Bitcoin, what seems like down now, 60% since February. Yeah, it went down 99% back in the tech bubble. So I guess there's more to go. But when you look at the entire space, Coinbase, down 40+% since the IPO. You have ARK Investments down significantly as well. You got software stocks already peaked back in February too. And a lot of the hype names like Peloton would be a great example of another one, or Shopify, things like that. I think they're all part of this sort of frothiness environment. But do I like the developments happening in the crypto and the people that are more aware of the monetary debasement problem? Yes, I think that's great. The issue is we have all the macro factors to die for gold and silver. And people, especially the prospects and people that want to invest at Crescat and talk about gold and silver. And the biggest question I have is not about how that's going to shape up. The biggest question I get asked is if Bitcoin is going to replace gold and silver. And I think that's absurd. That goes to show how the sentiment really is still, for the metals. Bitcoin is not a metal. It's never going to replace gold and silver. It may replace somewhat in terms of capital flows here and there, and may become more part of some folks' portfolios and pension funds and so forth. But gold is ultimately what money is, and it's still going to be that case. It's a tangible asset, and it's very, it's only not as useful as a metal itself because of the price. Otherwise, it would be. And so, there's certainly a need for metals like that. And so I don't, and I think I find it a bit weird to see that type of sentiment when we have, if you're coming back from Mars and I tell you, well, it's going on today with political environment on top of it, I think it would be all over gold and silver rather than asking the question of if they're going to be replaced by a technology or another asset that, may actually offer different propositions in terms of developments in general. So I think that's my view on that.
Yeah, I'm with you on that one. It's such a funny comparison to make, isn't it? And I get it. But to compare an asset with a 12, 13-year history to an asset with a 5,000-year history is like premature at best, but more likely it's just ludicrous. And I have a place for both in my portfolio. Like I'm a Bitcoin investor and a crypto investor, fairly passive and a dollar cost average in all this. But I've never been able to draw that comparison and like wrap my mind around that argument other than just like, to your point, frothy sentiment. This is the new hot thing. It's replacing gold because we love it now. But yeah, I'm with you, man. Okay. Look, Tavi, it's been great having you back on. Thanks so much for making the time to come back in front of my audience. I really do appreciate it.
Jay, it's my pleasure. I'm always happy to be here. So thank you very much for the opportunity.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I am joined right now by Shawn Wallace, the Executive Chairman of Torq Resources. Shawn, welcome to the show.
Thanks, Jay. Thanks for having me.
You know what? It's about time that I had you because maybe unbeknownst to you, I've been an investor in several of the companies that you've been associated with in the past. And so I'm very excited to dive into this one and introduce you to my audience. You're part of a group that's delivered several handsome returns for shareholders over the years in good markets and bad. And so I'm very excited that you're now leading a copper company in this market. And so where I want to start, Shawn, is with some of the trends that you're seeing in the copper space, because, I'm being bombarded by my audience for inquiries and opportunities in the copper space. What led you to jump into Torq right now, and what trends are catching your attention in the copper sector?
Yeah, look, we were putting Torq together prior to the, copper being as topical as it is today, because, one of the things in this, we want to talk about the characteristics of the copper business and being in the copper business. It's kind of like being the captain of a huge cruise ship instead of a small, more nimble boat that you would find, say, for instance, in the gold space. Copper deposits typically to be meaningful, the ones that have an impact on supply and demand, the ones that the world needs right now, take a long time to discover, a long time to drill off. They're huge. They take a lot of capital to get into production. But then on the flip side of that. They run for many, many, many years, and they create a lot of economic benefit for shareholders, stakeholders, and the like. Very topical right now. As the current ESG movement in boards and in corporations is afoot, and we really embrace that as well. You mentioned that you've been a shareholder in some of our previous enterprises, but my prior life before Ivan and I came together and built the group that we've been able to deliver those in the last 18 or so years. Prior to that, I was with the Hunter Dickinson Group. And so I really cut my teeth on big bulk tonnage, copper, gold projects, Mount Milligan, Camas. These are all projects that are currently being mined, being as part of the team at the Pebble project in with Northern Dynasty. That story's still ongoing. And as you can see, these are big projects, took a long time, a lot of players involved, and because the copper market is such that it's a real economic bellwether, and you're seeing that right now. And what's new this time, however, is that there are there always were new uses for copper as technology has slowed, but the pace at which the demand for copper, I believe, will be required here going forward. We have never seen it before. And that's all happening at the same time that copper really hasn't been something that junior companies have been discovering. Major mining companies have been hunkered down, mining the projects they have, depleting their reserves. And there's a real need now to replace them for the current and oncoming demand, in my opinion.
Yeah, you're right. And every macro trend is pointing to copper right now, whether it's EVs and the demand for copper, whether it's, it's funny, a question that I've gotten, actually was a statement that I've heard on this channel a handful of times, was copper is the new oil. And I put this as a question to some of the individuals that I speak with, like Rick Rule and Warren Irwin, and they fire back and said, it's not the new oil, it's the new pipeline. It's going to be required for everything, whether it's energy transport, new home builds, electric vehicles, the list goes on and on. But the renewable energy trend is probably going to be what we're all talking about for the next 5-10 years in mainstream media.
Absolutely. I concur with that. And you're seeing that.
Right.
And I think there's going to be other factors that people are going to realize how dear copper supply is. We're going to come into some real shortages, and you're going to have countries hoarding it, people buying stockpiles of it in anticipation of price appreciation down the road. I mean, one small example, as a number of years ago, I was involved in the platinum palladium business, and they came up with these I don't know if you remember a company called Ballard Power Systems, and they came up with this fancy fuel cell, and then you had auto manufacturers going in and buying up stores of platinum and investing in mining companies. And obviously copper is a much bigger conversation than, say, platinum palladium that's so specialized, but I think that was like a microcosm of what the macro, which is what I think copper, I believe to be with the far-reaching needs and its implications. As you said, it's not just the EV world, it's everywhere. And it could get pretty scary in terms of what the price can do, although I would love to see a higher copper price, and it'd be good if there's some order to that.
No kidding. Okay, now, whenever we see, given the macro environment and the hype and the sentiment driving investors towards copper, there's always going to be an increase in noise, Shawn, and an increase of companies that don't deserve investors' attention. So I want you to do us a favor and help guide investors. What can we look for? What should we look for when separating the great from the rest when it comes to early stage copper companies?
Sure. I think what I'm about to say applies to outside even copper companies. And as you point out, the thing, really, particularly though in the mining business, because this isn't a business that you can just show up in because you're an entrepreneur and do well. I mean, the amount of the sort of far-reaching implications of the technical prowess that your team needs to have. So again, to simplify it, the people. The experience. Have they found a big copper project before? Have they drilled off a big copper project before? Have they permitted one? And now in a modern context, and very importantly, how are they going to deal with the communities? Because these are usually big impact mines. They're usually out in the middle of nowhere. However, if there are no people close by, there are going to be if you're successful enough to have a mine, because you're going to have to move thousands of people to operate the mine. And all these things are opportunities, but they're also banana peels. If you don't have those things in place, you're going to slip and fall, and you're not going to be successful. I think the competitive landscape for, say, a group like ours, we look around, and we're not the only good or successful or experienced group doing this right now, but I can tell you, few and far between. So as you pointed out, the noise will show up because the opportunity is there. People are going to show up and, of course, touting big plans and things that they want to do, and bless them if they can do it. But my confidence, put on my investor hat, I would not invest in somebody who hadn't done it before. I just don't do it. It's too risky.
I'm with you. Actually, like exactly. It's funny. I talk about that all the time on the channel. I'm not opposed to betting on the rookie at all, right? Most of my life, I've been the rookie, right? Soliciting bets. Yeah, no. But, with my capital, when it comes to the venture market, I want to bet on success. Like success begets success. And so we want to look at the track record first.
Absolutely. And if it's a new CEO, for instance, for instance, like myself, I worked for 20 years with a group like Hunter Dickinson, learning all the things I need to do before I became the guy doing an interview like this. I was the guy in the back grinding away. I think you need to see at least that. I don't want to see some guy who was a weed CEO last week being a copper CEO this week. I guess if I'm going to put it bluntly.
Yeah, that's the best way to put it. Okay, now let's talk about Torq. You guys are focused in Chile, the Margarita project, and then you've been talking a lot on previous interviews about how you've been hunting for acquisitions. For context, today is May 25th, and this morning you guys announced a second acquisition, the Andrea project. So why don't we start with Chile? Shawn, why Chile?
Well, Chile, we like Chile for a number of reasons, and not the least of which is a number of our team members have experience there, so it's familiar to us. And, in the current business environment, which is, obviously we all know what that is and is difficult to operate right now, particularly when you have to do it by remote. We were well connected in Chile with those people. The thing that I hold most dear, the thing that has made me successful isn't myself, it's all the people around me. We were able to partner up with some fantastic people in Chile who have, so much experience, have made major discoveries there, have seen those discoveries through to production in some of these great storied deposits. So for us, that's a specific reason why we were there. But some of the bigger reasons why we're there, when we look at any jurisdiction as a group here, we look at, what's the mineral tenure system look like? Well, in Chile, they have a mineral tenure system. It's complicated, but it is tried and true, and it's been there for a long time. Can we navigate it? Yes, we can. Check. What about the environmental and social climate there? Is it positive about mining? Chile, yes, it is. Check. I mean, we've all heard some noise recently about, increased taxation and so forth, and I'm not going to get too distracted on that right now, but I'm just going to say that you can expect to see that in every jurisdiction, everywhere in the world, as long as these metal prices continue to increase. It's been my experience in my career, having worked in probably 20 different countries around the world over the last 30 years. Anytime we start getting success, or anytime the macros, the metal prices start to go up significantly, the governments look for their piece too, and I think that's all you're seeing there now. But I think it's manageable. I also believe we got to, it's not a banana republic in Chile. You got a proper government there, and you have an unbelievable bed of talent, technical talent, geologists, engineers, environmental biologists, all of it, labor, the whole nine yards. So that makes it so you can operate. When you have to reinvent all these things yourself, not only does it increase the risk, but it also increases the cost dramatically.
Yeah, 100%.
Those are a lot of the reasons. And then I guess the number one reason, frankly, the thing that none of us can control, which is the endowment in the earth. At the end of the day, for instance, and I'm not going to get too geological on here, but for instance, in the Andrea project, one of the things we love that, it's in the Miocene rocks. Well, all the great granddaddies of copper deposits are in there. We know how deposits behave in that geological environment. We know what to look for. We know the steps, and that allows us to manage risk, because managing risk is our number one job.
Okay.
Of course, our business is inherently risky. In other words, we're trying to find something where there previously was nothing. So that itself is inherently risky. So it's incumbent upon us as the leaders of these companies to make certain we can mitigate all other risks associated with. And Chile is an environment where that is imminently possible.
And Chile is where the copper is, as you said. So let's talk about the projects then. We'll get to Andrea, the new acquisition. Let's start with Margarita. You guys have been working on Margarita. You had a team down there doing surface work. I believe you have drilling planned for Q3, but walk my audience through what's occurring at Margarita.
Sure. I mean, it is an earlier stage project. In other words, there's not a resource there already. There's a confirmed copper mineralization, the right geological structure. It's in the right belt with other mines and well known. It's got good infrastructure. You can drive to it. It's and it's got all the work done to date. It was done very much in the way we would have done it. So what we've done though since acquiring it early in 2021 is to get our guys on, our technical people on the ground there, and sort of take our bite out of it in terms of prepping for drilling. So we'll go in and we'll do some more IP, tighten up the lines, and we had a news release about that, and it came out the way we had hoped. And so before you go do the expensive exercise of drilling, the ultimate test, throw the terrible truth machine onto the deposit, you want to make sure that you've measured twice so you can cut once, because it's expensive to do so. And and plus you can only permit so many holes at a time, so you don't want to waste a permitted hole on a sort of a duck hunt, if you will. So the project is shaping beautifully. So what we've done is we've gone in there, done all that early stage work, and now we're really preparing that one for drilling. We'll do the exact same thing at Andrea. Of course, we've just announced it today, but what people can expect is the dribble out of news as we prepare it, as we get more steadfast in our belief that this should be drilled. We'll be sharing that with everyone, as we have with Margarita.
Okay. And then, just given the track record of yourself and your team, are you still hunting then, Shawn, for more properties, more optionality? Talk to me about the future.
Well, there's every bit as much energy going into that as there is into sort of seeing these assets to their fruition. And so, the Andrea project represents sort of like step 2 in a multi-step population, if you will, of our portfolio of high quality assets. So these are just the first 2. We're extremely excited about them. I think that we could probably make a company out of the 2 of them, but we're not going to stop there. With the acquisition of our Chilean team, sort of a shadow team of us up here, which has been fantastic. The types of opportunities that we're seeing right now, really, I have not seen in my career. Now, everybody says that, but it's truly true. Nobody else is down around trying to acquire assets right now. So we're starting to, the quality and the scale of opportunity is only getting better. And we are well down the road on some additional assets right now that I hope to be able to share with as completed acquisitions with everybody here in the next 6 months or so. Okay.
Now, last question on Andrea, because I know you look at hundreds of projects. What caught your eye about Andrea?
Again, proximity. It's only 100 kilometers on a beautiful paved road. It's in amongst within a relative distance of a cluster of mines in the same rock package. There is mineralization all over the project. We believe that the drilling that was done, all it did was lead us to where we drilled. Initially, it had been drilled for epithermal gold veins at the top of the system, and with no consideration whatsoever that there might be a porphyry underneath. Well, there is. We've figured that out by mapping and trenching and all and that sort of thing. Or the people we acquired it from did that work. We haven't done any of our own yet, but we certainly went and did the comp for during our due diligence period. We confirmed that we believe that the reasoning is sound for drilling, and the opportunity for big bulk tonnage deposits exists. Again, having done a number of these big bulk tonnage projects in my career, a lot of those stories evolved the exact same way this one was. Someone, several years ago drilled looking for one thing. They kind of sniffed into the thing that we're now looking for, but they didn't recognize it then, not because they're bad or they're dumb technical people, whatever. They just weren't looking for that. So it wasn't a strategy. Well, it's our strategy, and we're quite happy to pick it up from here and see what we can do.
Okay, I like that. Okay, now, Shawn, just to recap what I see with Torq right now, why I wanted to have you on the show. It's the opportunity to invest before something big occurs with a team who has a proven, tried and tested track record. And, I'm talking about your background with Hunter Dickinson. Thank you for bringing that up. Your background with Ivan Bebek, a name who's familiar to my audience because he's been on this show a handful of times. You guys built and sold Caden Resources, built and sold Keegan Resources, and the team. We didn't talk about the president of Torq, but Michael Kosawan is another face who's familiar with my audience because when he was part of Sprott. He spoke at my investment conferences a handful of times. And then, of course, your chief geologist, Michael Hendrickson, who again he's involved in your family of companies. And I love when a company like Torq is able to pull resources from familiar organizations, right? And when you share talent and pool those resources, it only strengthens the whole.
Yeah, I mean, that's a lesson I learned from being at Hunter Dickinson. They ran a similar model. They got rather large, so our goals here aren't to get quite as large as they did. The size that we are now is probably us being as big as we want to be, nor do you think we will reinvent ourselves as mine constructors or that sort of thing. If we, for instance, you referenced Keegan was a success. We didn't sell the company, but what we did was we found a mine. There was no transaction to be had, so we brought in an operating team, and I still actually sit on the board of that company. I'm sort of a legacy director still, but it's, producing over 400,000 ounces of gold a year. Caden was probably our more preferred exit, if you will, with a nice premium takeover. And that really put the wind at our backs to create the companies Orin, which I'm sure are the ones that Ivan's been telling you about more recently, or the spin-outs from there, and now Torq. We were able to populate these companies with shareholders and capital early on that you wouldn't be able to do thanks to that wind at our back and that track record and that collective pool of talent.
Okay. Look, Shawn, thanks so much for making the time. Torq trades in Canada under the ticker TORQ, and in the US, TRBMF. And I appreciate you coming on, Shawn. Love to do this again down the road, maybe 3-4 months, catch up on what's changed.
Sounds great. Look forward to doing it. Thank you very much.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now once again by Warren Irwin, the founder and president of Rosseau Asset Management. Warren, how you doing?
I'm doing great, Jay. How are you?
Really good, really good. Glad to have you back and excited to jump into a bucket full of topics here.
Right on.
And why don't we start? You're one of the original value investors in the commodity space, and we could get into some pretty wild stories that maybe I'll try to pull out of you towards the end of the interview, like your experience investing and then eventually shorting Bre-X back in the day. One of the first investors to see that for what it really was. It came to mind because I just hired somebody new on my team, Warren, and Bre-X came up in conversation yesterday, and she didn't know the Bre-X story. She's new to the commodity sector and all this. And I said, okay, well, what you shouldn't do is go and rent the movie Gold. What you should do is pull up Warren Irwin's article, I think on CEO.ca, where you ran through that whole story and then you speculate about what really happened, answered a lot of the questions that never really got answered, right?
Yeah, there's probably a hit on me now because I've basically been telling everybody that Mike de Guzman's alive, living in the Philippines, and friends of mine have seen him. So yeah, it's rather controversial. And I think if you want to learn as a junior resource investor, I think my little 4-page article on Bre-X and my experiences with it is the most worthwhile use of your time, I think, in the world, because in those 4 pages, you will learn lessons that I agonized over for a number of years to learn. And
right.
If you're smart enough to pull the lessons from that, you'll learn a lot in a very short period of time, and at my expense. So
right on, yeah.
I've learned those lessons.
Yeah, and you were a very young man, and you actually you went to Indonesia, right, to do firsthand diligence. Didn't get a lot of the questions you had answered, and that's what initially arose suspicion. Correct?
Yeah, no, it's a lot of things arose suspicion for sure, and the biggest one was it's explained in the article is Dale Hendrick, who's an old-time mining guy who's recently passed away, but he saved my sorry little naive ass by explaining to me the mining business. And the stories he told me, frankly, were unbelievable about, just everything from exploration managers taking per meter kickbacks from all the drilling companies and just how the mining business works, the level of corruption in the mining business. As a young, naive investor who just came out of MBA school, I'm thinking, the world's good, decent, honest people if you work hard. And, that's so I quickly learned that, and then being thrown into the snake pit with BRIACs and having to learn with that and the corruption of the Indonesian government and the corruption of the players involved in the thing, I was thrown into the deep end pretty quickly. And because, I'd taken a very, very small amount of my savings, I think $80,000 I started with, and I tripled in a real estate deal, buying distressed real estate. It was a publicly traded company. So I had $250,000 back in, let's say, 1994, 95 timeframe. And at one point, I had as much as $5.8 million worth of BRIAC stock. And this is a long time ago when 5.8 was considerably more money than it is today.
Mid-90s,
I had $1 million on margin too, because I thought margin was $1 million margin, almost a $6 million position was prudent. But in hindsight, it wasn't very prudent. Unfortunately, I got off margin. But those are the lessons everybody learns. And fortunately, I came out with the skin still attached to my body. And so let's see what happens with this resource market. And
all right.
We're going to have some fun, possibly, if it turns out the way I think it'll be.
Well, let's talk about that. So, it's been a pretty sleepy start to 2021. Gold price has been pretty flat, if not down, but recently breaking out. Copper's been hitting all-time highs, but the equities haven't really responded. What are you seeing right now, Warren, in the market that's catching your attention?
Well, the big thing is, everybody's aware of the underlying inflationary trends, right? So we're all aware of the U.S. government's printing money. Countries around the world are printing money. Everybody knows that they're fudging their CPI numbers. Anybody who goes shopping, anybody who tries to build a house or do anything in this world knows that the price is going up of the items we want to buy is going up more than 2% a year, right? So that's the theme. And right now we're in a very unique position because we're getting, COVID's ending and we're getting a massive ramp in consumption. People have been sitting at home. They've been consuming. They've been saving their money in a lot of instances. They've taken the government funding and they're starting to spend it. You're seeing it with right now record housing starts in Canada. So, I live here in British Columbia. We all know what the pine beetle did to our forests. And, for how many decades have we heard about all the different lumber mills being shut down? And, here we are now, boom, we got the biggest boom in Canadian history building homes. And guess what? Our forests are all eaten by the pine beetle, and the remaining lumber yards that we do have, lumber mills, are going flat out. My guy who I'm renting a house to works as a foreman at one of the lumber mills here locally. And he's just working night and day, weekends, time and a half, double time, like whatever. And they are churning out as much lumber as they can to try and meet demand. I'm trying to get some stone for a patio from China. I paid for it at the beginning of December. It's not here yet. I just got notified my shipping costs are going to be doubled, and that there's 3 shipping companies didn't even want to ship it because there's no capacity on the shipping. One thing we're going to see here too is just ask yourself and your friends, what's going to happen to the airline sector when things fire up again? What's going to happen to oil consumption when the economy gets going again? I have lots and lots of global travel that's all built up that I have to do. And I have to see projects in other continents. So I'm going to be jumping on a plane. Everybody's going to be jumping on a plane, and everybody's going to be putting more gas back in their car. So we're going to see a massive spike in recovery in oil like we've never seen before. We're also seeing some other very amazing trends. Like we're seeing the whole EV trend starting to warm up here. And people are saying, well, we haven't built too many copper mines recently, and these new EVs take, anywhere from, 3 to 4 times as much copper as a regular internal combustion car. And, if I ended up getting a electric Audi and parked it in my garage, well, my electrician will come and say, Warren, well, here's the cost for that nice big thick copper cable from your main electrical panel to go out and charge your electric vehicle now. And you multiply that charging cable by the number of people that need to do it. And every condo in Toronto and Vancouver and big cities, you're going to have EVs there. You're going to have to rework the entire electrical system. You're going to have to increase the amount of amperage and coming into the coming into the condo, and then you have to run a lot of electric wires, a lot of copper. And then you even take it back further. You see it firsthand with the failure of the Texas grid. The grids in the US are in very bad shape. So how are we going to run EVs on the grid? So we're going to have more copper for the power infrastructure, charging stations, whether it be public charging stations, people's houses, and then just for the EVs themselves. And here we are. We haven't really built too many big copper mines recently. So that'll be an interesting theme here the coming decade or so in Copperland. And copper cannot be substituted. It's not like you could substitute it out. Whereas, when you're looking at battery metals, and a lot of people hype up battery metals, and I talk to people about battery metals, and they say, Warren, what do you invest in for battery metals? And I said, nothing. I said, I invest in copper. There's lots of lithium out there, and the big producers can produce, I think, enough lithium, and it's reasonably, there's enough lithium out there. I'm not worried about lithium. And they said, well, what about cobalt? It's very rare. And I said, yeah, and that's why every battery engineer in the world is trying to engineer out cobalt. So if you go out and find a primary cobalt project, by the time you get it financed and built and everything, there's a very good chance cobalt will be engineered out of batteries by that point, and possibly just used in maybe super high performance niche batteries or something like that. But there's going to be a lot of changes, which I cannot really predict, in the metals that go into batteries. Because the battery is such an integral part of the cost of an electric vehicle, there will be massive amounts of R&D put into minimizing the cost of an electric battery that goes into these cars. And in addition to, cycle times, recharge times, things like that, or the number of cycles it could have. So there's a lot of stuff going on there. But I'll tell you that many of the things that I mentioned in Copperland, which is, just you need copper for electric motor, you need copper for power lines and charging stations and things. That's not going to change. So copper will not be substituted out. There will be some substitutions made in battery land, and everybody is trying to get the cheapest battery they can, because the cheaper they can make that battery, the cheaper EVs will become, and the quicker there will be adoption. And when all that happens, it's all going to push forward as much demand for copper as they can. So
I love that. Okay, there's a couple statements you made there really summarize my sentiment in the battery tech space as well, which is nice because, this is what we've been talking about in the channel. So I feel like my audience is quite aligned when you say things like, there's going to be a lot of changes in battery land that I can't predict. There's going to be millions of dollars thrown at R&D in order to get the cost down. That's going to change the ingredients required to build these batteries. And because we can't predict those unknown variables, but we can look at copper and say that's going to be the stalwart no matter what. You need this. For that reason, I haven't covered cobalt on the show, covered lithium a very tiny bit, but the focus on the energy revolution has been all about copper. I got to ask you though, because, a line I often hear, Warren, when we talk about the battery tech sector is copper is the new oil. But what's your reaction to that statement?
Yeah, that is truly one of the dumbest statements I've ever heard. And I believe it, I'm not sure who it came out of, but I believe it was a large U.S. investment bank who should remain nameless. That shows to me the level of dopiness in this whole sector. And we're at the early stage of the big copper rally, so people don't understand copper. They don't understand the role of it. Copper is the pipeline. Copper is not the oil. The oil going forward will be uranium. Uranium needs to power the nuclear reactors, which is one of the only ways you could generate CO2-free baseload power. The other one is hydro. We've already dammed up all our rivers. So going forward, trust me on this one, it'll be a uranium market. So that's why if people ask me what I'm playing two things. I'm playing the only source for baseload CO2-free power is nuclear power. It's been generating the last 50 years, in the US, safe CO2, non-CO2 generating power. Going forward, I'm aware of some of the technologies. I have a friend of mine who works at Terrestrial Power. They're makers of these new fail-safe modular reactors you may have heard of.
Yeah.
My big thing, I'm like every human on the planet, I'm concerned about safety. The reactors globally, there's about 450 of them in operation. They've been in operation for a long time. They've been operating safely. There's been Fukushima was a tragic accident, and then of course, Chernobyl. Well,
Yeah.
you can't fix stupid, right? So, but there's a whole new generation of fail-safe reactors where the fuel is already in liquid form, so that when power is stopped, being put into the process to generate power to create the fission reaction. When that power stops, as in the case of it was Fukushima, when the power generators were eliminated, the process just stops, and there's no spontaneous meltdown.
Yeah.
And I'm a huge fan of these new generation modular reactors because they don't take up a lot of space. The important thing with nuclear power is the standardization of component parts in nuclear reactors. And once we get a standard, let's say 300 megawatt modular reactor that all uses the same parts, well, you put 4 of them together to create a 1.2 gigawatt power facility, and they're all using the same parts. So if one part breaks or one part needs servicing, well, guess what? There's lots of them on the shelf. There'll be like, a couple hundred of these modular reactors around the world. And so you get a level of economies of scale, because right now, with current standard technology, every new reactor to a fair extent is like, let's take a blank sheet of paper and we want a 1.35 gigawatt power reactor because we've done all our electricity counts and our growth projections, and that's what we need. Well, yeah, I think in the new world, and we don't know when the new world is going to happen, we'll just say, okay, well, 1.2 gigawatts is close enough. Let's put in 4 300 megawatt modular reactors. And then once if you need a little bit more, we'll tack another one on in about 10 years' time.
Right.
When consumption is there. So that's how I see the power grid building going forward. I think wind power, it's nonsense. These things are Stone Age technology, and their lifespan is not great. You're looking at nuclear power plants with they're expanding their lifespan to 80 years. So we're talking, can you imagine a nuclear power plant running for 80 years? Like, that's how you really bring down your cost per megawatt generated, is having these massive long lives. But you would get 20 years out of a wind farm, and then what do? You can't recycle this stuff. You have to put it in a big landfill. And
so why
windmills are huge?
Why does nuclear get such a bad rap? Because even you mentioned, like, we all know Fukushima, and it was a horrible disaster, but it was one disaster, right? How many oil spills, pipes burst every year in the sector? Yet we don't point the finger. We still reference Chernobyl, which is in the 80s. Why does nuclear get such a bad rap? The infrequency of disasters is notable, yet it's the black sheep.
Well, any competent scientists. And we're talking competent scientists, like ones unrelated to highly politicized groups like Greenpeace, where they're living in their own fantasy world. Nuclear power is by far the safest baseload. And all you have to do is look at the deaths from. There's been 3 even remote nuclear accidents in the world. Fukushima, I think they'll say 1 or 2 people died as a result of that related to the reactor. The rest were due to the tsunami. And in 3 Mile Island, nobody lost their lives, and there's a small release of radiation there. But Chernobyl, what are we up to? The numbers are questionable. What the number is? Is it 50? Is it 100? Is it 200? Who knows? Yeah. That was a bad accident. That was bad design, incompetence, a whole bunch of things that are typically endemic of the Russians running these reactors. So, but when you look at all those numbers, well, let's say it's 200 people or whatever the number you want to pick. Well, you take a look at history of the number of collapsed power dams, and where they just wipe out villages downstream and kill hundreds. And look at even some of the tailings dam accidents, with Vale down in Brazil, and the hundreds of people killed there with these dams collapsing. So dams collapsing has killed way more people. So in baseload, there's really 3 baseloads. There's coal. I think everybody knows that coal, the number of pollutants that go into the air have killed a lot of people very, very early, especially in China. the collapses of power dams throughout the world have killed hundreds and hundreds, if not thousands of people. And then nuclear is, what's the number? It's not a super huge number. So what's happened there and why people are anti-nukes, I remember I grew up in the 70s, right? So, and it was all Greenpeace putting out their Greenpeace flags, anti-nuke. So, who was financing Greenpeace back then? Well, who had the most to lose? That was the coal industry, thermal coal. So they were kicking all the money they could to Greenpeace. And Greenpeace was hyping everybody up about how bad nuclear power was. So thanks to Greenpeace, instead of having nuclear power research for the last half century, we've been burning coal. Thank you, Greenpeace. What has burning coal done to the CO2 in the atmosphere? What has it done as far as killing people with the pollutants in the air? It's one of the biggest environmental travesties, I think, because if we stuck on the path of nuclear power, can you imagine where we'd be today after 50 years of research into nuclear power and improving on what we had? Well, guess what? Nuclear power research is virtually shut down for the last 50 years. Fortunately, some hardcore people stuck to it. So that's why we're getting the next generation of Gen 4 nuclear reactors. So that's my take on it. And, here we are today. When everything's pretty darn obvious as to what's going on, you've got Greenpeace is still anti-nuke. Well, I don't know what you want to power your vehicles as you go to your protests with. You want to, fairy dust doesn't work very well in vehicles, and you need some form of non-CO2 generating energy that's fail-safe. And nuclear power is the future, I believe, and that could be fission now. In the future, if they develop new, thorium reactors with fusion or whatever else, but to rely on Stone Age windmills in this day and age is pretty ridiculous. And you see the blight in the landscape. I'm originally from Ontario, my family farm, where we cut it out of the woods in the 1800s. And when I go up there and I see the travesty of the wind farms and what they've done to the landscape, and then what's going to happen in 20 years when they all wear out and have to be buried somewhere. Like it's truly terrible. And forgetting about the wildlife it's killing. And then, solar, well, we live in Canada, how you go a month in Vancouver with no sun, right? So how are you going to power your Apple laptop with that, right? So.
I'm with you. Okay. Let's jump back to the copper sector. I love your analogy there. Copper is the pipeline. So what should investors be paying attention to, Warren? Is it time to play the early stage explorers? And if so, what should you be looking out for? Are you looking at majors? What are you looking at right now?
Yeah, well, there's a number of different ways of playing it. I'm particularly right now positioned in a reasonably more conservatively than I typically would be. I have a big position in Cornerstone, which is I think I'm the third largest shareholder in it, just under 10%. And that was originally a position in SolGold, which is one of the world's biggest new discoveries of copper is taking place in Ecuador. So it's a little bit more senior than I'd like. It has a pretty big market cap, approaching $1 billion between the two companies. So it's probably more senior than I like, and so I anticipate what'll happen here is we'll get that sold over the near term here. So basically, you break the copper business, investing into a number of different tiers. The big ones, which are like the Freeports, right? The Freeport's gone from, let's say, $10. It was trading there for forever in the $10 to $15 range. Now it's over $40, right? So that's sort of, if you're a big pension fund and you want some brain dead exposure to copper, you buy Freeport, and then there's there's First Quantum. You could also get some exposure in copper through Teck, right? Teck has other assets too, but First Quantum and Freeport. Those are the sort of the ways to get existing big producers. A good thing about those guys is that when the price of copper goes from $4.75 to $5.75 to $6.75 to $7, they're actually making money as a result of that, because they're producing every day and they're selling it at higher prices. Then there's below that, there's the next tier, which I'm involved in, which is the new discoveries, which have gotten reasonably big. And they generally have around, 800 to $1.2 billion market cap. And there's about 3 of them out there that I'm aware of. There's recently there's a discovery really nice discovery hole here. Maybe not discovery hole, another step out hole for Filo, which has a copper project up in the peak of the Andes on the Argentinian-Chilean border in the San Juan province, Argentina. So they pulled a hole, I think about 850 meters of 1.8% copper. They hit a feeder zone. That's a tremendous hole. And then there's also Solaris has a copper discovery in Ecuador. I'm not following it super closely. I have enough Ecuador exposure. When I looked at Solaris, I found it to be very expensive at the time, which was 6 or 8 months ago.
Right.
I found it to be expensive, and I found it to be reasonably tight shell. So it was not my thing. But so now I'm involved in one of the problem children, I think, right now of the copper space, which is Sol Gold. They have the Cascabel discovery in Ecuador, and they have one of the biggest land holdings in Ecuador. Ecuador, frankly, is a tremendous geological setting for copper because it just continues up the copper belt from Chile, Peru, then Ecuador. The reason we haven't found big copper discoveries before in Ecuador is just due to the fact that you can't fly over the plane and see the Gauss, and you just see jungles, and it's tough to get through that jungle cover. So there are new techniques that are being used, and Sol Gold pioneered some of them. They found a multi-billion ton copper project, but then we've had some problems with management on it. But those are getting gradually sorted away, and so it's kind of an interesting situation where you have pretty much a very well drilled out copper project. They're looking for a new CEO. The current interim CEO is a former Rio Tinto executive, very solid guy, Keith Marshall. He's redeveloping their mine plan to focus more on the high grade core to get your capital back, and then start mining from the core. So he's redesigning it to make a much better return on equity, much lower capex and things like that. So that's sort of a bit of a problem child, but they have a massive discovery. So I'm reasonably positive on that because I think it's exactly the type of project that the majors will want, and specifically the Chinese and the big mining companies will want a project like that. And it has not. I think in the last year it's probably down 20-30%, despite having one of the world's top undeveloped copper projects. So there is some hair on the name, but the hair is getting fixed, and I could see in the next few months there will probably be an announcement that they'll have nailed a new CEO. Hope they make a good choice.
Yeah.
And they seem to be considerably more reasonable than they were in the past with some new board members. And so I'm hoping that the Cornerstone Sol Gold start playing together a little bit more friendly, and they work together to maximize value for shareholders. So that's one I like because there's not a lot of froth in it. It's super duper cheap, and there is a big discovery there. And Ecuador, the good thing about Ecuador is they just had their election. So for the next number of years, hopefully, there will be some level of stability in Ecuador with respect to mining. But in the past, I've been burned in Ecuador, so
Got it.
I do have a bit of history there.
Okay. I think that I'm seeing a emerging wave of early stage copper explorers getting ready to spend marketing dollars, getting in front of investors, and the real spec stuff more in. What are some rules of thumb that myself and my audience can apply when we start looking at the plethora of super early stage copper opportunities to weed out, the 80% that aren't worth our time? What should we focus on? Okay, well, they're the sort of the third tier. So you got the Freeports, then you have the Sol Golds, the Filos, the Solarises, right? And then you've got the earlier stage stuff. What you really need, what I look for, let's say at this stage of the cycle, first of all, we don't know how long this cycle is going to last. Cycles, like I mentioned, before, are sometimes happening quicker than they would otherwise happen, and they end a lot quicker than you would typically expect. So in a normal cycle, you'd expect a 10-year cycle. So we might only have a 5-year cycle. So being conservative, I'll have to conservatively think we're going to have a 5-year cycle here. And if we're lucky, we'll have a 10-year, possibly a 15-year cycle.
So if we have a reasonably short cycle, for me to be financing, green fields, as in one guy just going into the jungle with a hammer to do some prospecting, that's going to be a tricky one, because by the time they get in there, then they stake their claims and they build their exploration camp, cut down a bit of the jungle, do some drilling and try and zero in on a discovery. It'll take many, many years. And by then, the whole copper picture may have changed. So I like guys who are just a little bit more advanced than that, as in what's nice about it, for instance, Sol Gold has a number of these projects throughout the country where they've spent the last 2 or 3 years doing a lot of the preliminary work. So they have a 2 or 3 year head start. Okay. And that they've already done the work. They've already done the geophysics. They have a good sense. So they've already found copper. They've already chipped some rocks, pulled out some copper, sent it into the lab. You may have a drill hole or two. But so I think at this stage, I would probably stay away from the grassroots. Try and find a junior with an angle. So they've probably got perhaps 2 or 3 years already of exploration in there. They're zeroing in on possibly some drill ready targets. They might have a drill hole or two. They have some really good geophysics. They're getting some really good, stream sediment samples. So it's clear that they're at least 2 or 3 years into the exploration project. The next thing is, I was pitched, in fact, this morning a deal from another country, and they were asking if I was going to invest. And then I looked at it and I just go, well, if you're going to be investing in copper, you got to invest in scale, right? Copper mines aren't little mom and pop mines like you can get gold mines like that in a lot of countries around the world. You need scale, so you need the next massive mine, and so you need a situation with scale, and you need grade. And the other thing, the tricky thing to watch, okay, and you can see this in a number of other commodities too, is when you start seeing the grade and people saying, well, XYZ mine used to mine 0.3 copper, so we're 0.3 copper, which in my opinion is way too low. It doesn't cover enough management scrub. So if they're saying, well, don't worry about the 0.3 grade, we know it's crappy, but there's 3 mines in the world that are mining 0.3, and they're absolutely right, but those mines that are mining 0.3 started out at 3 or 4% 100 years ago, right, and are now down to 0.3. But guess what? In that period of time, they fully paid for their mill, they fully paid for their staff accommodations, the roads, the power lines, all the infrastructure. So they're looking strictly at their variable and ongoing maintenance costs, and they're going, yeah, well, 0.3, yeah, we can make money doing that. We've got a workforce is already trained and already. They're really good. They could really make this 0.3 sing. But on a new startup, 0.3, like that would be really a tough one. So that's one thing I'd worry about with people. And I'm seeing that in one particular nickel situation too, where the grades are so outrageously low, I just fall off my chair. And nickel's a whole new story, because there's the whole smelter issue too, because you can't, you need to use a smelter to get certainly nickel sulfides into nickel forms, and those smelters are usually owned by a large mining company, and they usually take a massive pound of flesh out of you. So you can't be playing with thin grades in nickel. You need good grades. And so with copper, if I was making a suggestion, I would say look into. Make sure you're in a good jurisdiction that ideally has a mining history or is positive on mining. Make sure you've got a bit of grade just in case screw ups happen. If you need to run another water pipeline, or if you need to run some hydro lines or build some roads or something like that you need. And so if you're in a good jurisdiction, you've got some good grade, and then you need scale. The bigger the scale, the better. The big win for any junior resource investor, and this is the way, if I could summarize how I think, and it's worked very well for me for a number of decades, is look at projects as if you're a major, saying, okay, will this project make a difference to Rio Tinto or BHP or any of the majors, or Freeport or Teck or any of these big guys? And if it won't make a difference to them, just don't invest in it. If it's in a jurisdiction that they wouldn't like, don't invest in it. And if we're dealing with some new metallurgical issues that you need to extract whatever metal out of the mine, well, just leave that for somebody else to pioneer. Stick with proven technologies, grades, scale, jurisdiction, and there will be some money made in this cycle. And in a hot cycle, everything goes up. So that's another thing you got to watch out for. I remember the last really fun mining cycle was sort of in the 90s, where you had every piece of junk gold company with 100 million market cap. So all you needed was a liar CEO, and you needed a property, and you needed that's my alarm going off. So there it goes. So you needed a lying CEO, a property, and a listing, and you had 100 million market cap in the mid 90s in the gold.
Yeah.
So if we get hyped up so much like that in the copper business, and there's a very decent chance we could have a really rock and roll copper cycle this time, just remember that lesson that guess what, like just remember when things get frothy that things are frothy, and in a down cycle, and remember, no matter what, copper is cyclical, like every other cyclical thing. The mining cycle is cyclical. Remember, on the downside, you probably don't want to be owning a lot of the junk that the guys from Reddit and who just left Bitcoin are jumping into the copper play, and they've ramped up a couple of moose pasture copper plays to 250 million market cap.
Right.
Don't put your children's college savings in that. And how this, if you want to ask how this copper cycle is going to end, well, it's going to end when we've had a ton of money raised, focused on copper for the next decade. And at the end of this decade, assuming it's a 10-year cycle, high prices are indeed the cure for high prices. So we get a lot of high prices. We're going to get a lot of young guys, really smart, good geos, fresh out of school, maybe with a bit of experience. They'll be out there banging rocks around the world. And we're going to find another Escondida or a few others. And look what Robert Friedland did with Ivanhoe mines, like Kamoa and Kapushi. Not Kapushi, but Kilkula. Kapushi's it has copper in it, but it's quite a bit of zinc too. But Kamoa and Kilkula, like Kamoa, the size of Manhattan, right? And Kilkula, the grades there are like absolutely killer. Well, there's no reason that there's no surprise there that the Chinese wanted to buy into that. So So we're going to see some interesting discoveries over the next decade if the copper cycle develops the way I think it will. And this could be a very unique copper cycle, because in previous copper cycles, nothing about the demand for copper has really changed. It's just that, China needs more demand for copper. So the copper goes up, and then China, turns the urbanization slows down a little bit, so they don't need as much copper for the copper pipes that all the houses are building. Then the demand comes down as the supply goes up. But it'll be interesting to see this EV boom combined with COVID recovery, combined with so many other pro-copper factors.
Yeah.
What could happen? Like, the other interesting thing about copper is in the old days, they used to make door handles out of copper because, viruses do not live on copper. And they switched to cheaper stainless steel, and stainless steel is not as ideal as copper. Robert Friedland will tell the world this too. But copper in an operating room, if everything was copper, that would be better. The reason it isn't is it's more expensive. And in the future, we may see more copper in applications like that. So copper has a lot of interesting applications. It's a fascinating metal. And I think we're in for a number of really good years for copper.
I love it. Warren, thanks. There's been tons of actionable insights. So thanks for your time. I know you got to hop a plane, so you got to run. Your alarm is going off there. So thanks for your time. Thanks for coming back on, and I'd love to do it again sometime soon.
All right. Thanks so much, Jay. Have a great day. Cheers.
You too.
What I love to do is introduce the right people to the right people. I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I am joined once again by Rick Trotman, the CEO of Barksdale Resources. Rick, how are you?
I'm good, Jay. I'm good. Thanks for having me on again.
I'm really happy to have you on, Rick. It's one of my favorite things when I sit down with a CEO of a junior company and they run me through their ambitious strategic plans and all the things they claim they're going to do. But then I sit down with them again 6 months to a year down the road and they did everything they said they were going to do. And so that's why we're sitting down today. I want to talk about what's changed with Barksdale. Congratulate you on your hard work and update my audience who has been following the story for close to a year now. So before we jump into that though, we've always got new viewers. So if someone's unfamiliar with the Barksdale story, Rick, can you just give us the 30-second highlight reel? What is Barksdale Resources? And then we'll dive into some details.
Sure. Yeah. So we're a base metal exploration company with a focus in kind of the desert Southwest. So Southwest United States and Northwest Mexico, where we've got two core properties. One in Arizona, where we have a collection of properties where we've been consolidating this district for a couple of different years, and it's a world-class district with a fantastic property, kind of anchored around a multi-billion-dollar diversified mining company's core project, and that's our Sunnyside project. And then down in Mexico, we've got a very exciting copper oxide drilling property that we're going to be working up here shortly. So between the two, we've got kind of the near-term drill results that are going to be coming out on the copper side, and then up in Arizona, we have kind of the medium-term permitting play, and then ultimately very drilling programs that will occur up there once we have those permits in hand.
Yeah. Okay. Now I want to talk about consolidating the district. That's obviously what I was referring to when we jumped on here. And, there's been a massive surge in copper prices and definitely a surge in investor interest. And all the gurus that I sit down with, we talk about how to value copper companies and how investors can make a mistake just thinking about them like another gold company, right? And it's not the case. The exit strategy is very different with copper companies. You need a very distinct angle. And that's, I believe, why you were hunting the consolidation of this district. Something that you've been trying to do for a couple of years, but other companies have been trying to do for many years. So why consolidate the Sunnyside Copper District, Rick? Why now?
Yeah, so right now, look, we've been working on it for years. So I think the key thing for shareholders to realize with us is that we determine a strategy and we march the path. We don't necessarily care about what the cycle timing looks like or where we're at with respect to prices. Like, we know where we're going to be able to add value, and we kind of march that path. Now, the cycle timing's working out in our favor because it's all kind of lining up. So that's fantastic. But the real emphasis for getting the district consolidated, specifically the Sunnyside asset consolidated, is that we are nearing the end of our permitting process at Sunnyside. And having consolidation occur before we start drilling is going to be of the utmost importance. The last thing that we need to do is put out some spectacular drill results at Sunnyside and then leave investors with this problem, right? This math problem where they have to try to determine how much value should be ascribed to Barksdale versus the joint venture partner Regal that has a minority interest. And ultimately there's an overhang on both companies from a value perspective. Joint ventures become sloppy to kind of operate and to kind of advance from that perspective. So consolidating it ahead of the actual drilling just makes a lot of sense. And for years, we've been trying to get a deal like this done. But unfortunately, we had really, in my opinion, bad management at our joint venture partner's helm. And so that recently changed. They put a whole new board of directors in place. And those folks are a lot more commercial and easier to deal with. And they understood that they just can't hold on to hopes and dreams and believe that that's going to turn into real value for their shareholders down the line. So,
okay. So
finally.
Yeah. Well, I love it. As a shareholder, Rick, it's what I want to see. For context, give me a little bit about the background, and we don't have to go too deep into this, but just for context, what is the background with the JV relationship with Regal? What was that? And that'll provide us some context with why it's important that it's changed now. And you touched on it a little bit, but just a bit more clarity for me.
Yeah, so the relationship there's been a bit acrimonious in the past. We optioned the Sunnyside property back in 2017 and started this permitting process. And that permitting process has just taken so long. And to no fault of ours or anybody else's, like the U.S. Forest Service is hard to deal with. And I think all of our investors at Barksdale realize that, it's been a long time coming on the permitting side. But I think the other side, our joint venture partners always viewed those delays as being purposeful. Like somehow we're doing it to spite them and to deprive them of value, and that's not the case. And so we had these folks that were managing the company that just had all these fears in the back of their head, and just always felt like they were getting a raw deal, and they're just not very good business people at the end of the day. And so luckily, the shareholders of Regal, which is the company, they got rid of that whole management team, kind of sent them out with, holding pitchforks and lit torches, so to speak. Last summer, it was a pretty interesting process. And so then we got a couple of business guys that actually came into the board that have the experience and understand where value lies within a company. And so we were able to get a deal done. It wasn't easy. I mean, they walked us up in value a couple of different times. They got a victory for their shareholders. So, but at the end of the day, I think, all of us are now going to be rowing in the same direction. We're all going to be linked at the hip in terms of value. So it's a great deal overall.
Excellent. Okay. Now I want to talk about what we can therefore look forward to, right, in the future. And I know, so I see it as Sunnyside is the big news. This is the big catalyst that I've been waiting for, that shareholders have been waiting for, but it's not the near-term catalyst. We're going to get into what's going on at San Javier, because that's where we're probably going to see news first, right? You've got this high-grade deposit at San Javier. So we'll talk about that after, but let's wrap up Sunnyside first. So what can we look forward to, Rick, in terms of news flow? What can we expect in the pipeline?
Yeah. So at Sunnyside, and like you said, it's kind of the powder keg, right? Like the fuse is smoldering, and at some point it's going to go off. We're finishing up the permitting process this year. I'm very hopeful of that. So we've gone through our public scoping or public comment periods rather. Those are done. The final environmental assessment is being drafted now. And so we're hoping that in late summer, early fall, we actually get that preliminary approval. The draft FNZ, as they call it, the finding of no significant impact. And so that will be like the first key milestone, first deliverable on the permitting process that we will actually report to the market. We stay pretty quiet as far as news releases on permitting, because people just fall asleep. They don't care. Unless you have the permit, they don't care. And so that's going to be the first one that we can actually put out. And like I said, end of summer, beginning of fall, that's when we're going to look forward to that. And then a couple of months later, that's when we final approval. Once we put bond, we'd actually be able to start drilling. So the dominoes are starting to fall, and hopefully, they continue to advance according to schedule that we've been presented by the Forest Service.
Okay. So while we're waiting for that, we can focus our attention on your high-grade deposit in Mexico, San Javier. And it's what struck me when we first met. You and I met at a cactus club a year and a half ago, when we could still meet at cactus clubs. And, your background in banking, all you would talk about is the optionality and the importance of optionality in companies, which struck a chord with me. So that's what we have done in Mexico. This is where we're going to see news come out first, because we're close to drilling, correct? So let's talk about that. What's going on in Mexico.
Yeah, so we've made some really great progress in Mexico. I mean, it's been painstakingly slow because of COVID. We had some issues with our subsidiary and getting it geared up to do business in Mexico, because you have to have a bloody person go to a meeting in person with documents to get all of these tax numbers and things like that, where you can do it in the States in 5 minutes online, right? So that was a bit tough. All of that's behind us now. Our permits are filed. We expect in the next couple of weeks to actually receive our permits to allow to drill there. So we're hoping that once we have the permit and we secure a drill rig, that we'll be off to the races and drilling I'm hoping we're drilling by July. And so it'd be fantastic. That'd be the first drill hole that Barksdale puts in as a company, right? After 3.5 years, that'll be a major event for shareholders. So it's pretty exciting. But then, like you said, San Javier's got a lot of optionality. There's an existing resource there that has 600 million pounds of copper in it. It had an old PEA that was done on it that has a $200 million NPV at $3 copper. And we think that they got it all wrong, right? We think that the resource that they put together was a little too simplified. I think that there are structures and high grade opportunities that are within this lower grade deposit, so to speak, that will really add a lot of value. That's what we're looking to drill when we get in there and kind of this summer program that we're going to start. So hopefully we can make it bigger within the same footprint and then start to step out and expand it, and then go to kind of the targets that are further afield and start adding more copper. Because at the end of the day, this is at surface copper. It's oxidized for the most part. Some zones aren't, but mostly oxidized. You can heap leach it. It'd be a very low CapEx, simple project to put into production, and one of those big porphyries that is going to take billions of dollars of capex and a 15-year time period to get into production. This one can be simpler, it can be more nimble, and you can push it through a lot quicker. So like you said, it's got tons of optionality, and we look to kind of exploit that optionality for the benefit of our shareholders over the next, starting in a couple of months and going over the next couple of years.
And given what we know and the history at San Javier, what kind of grades are we looking at, Rick?
Yeah, so the existing resource is kind of a 0.35% copper, oxidized. And so, this isn't like a sulfide operation where you float it off and send a concentrate. You actually produce plated copper cathodes that you deliver, and you actually get a small premium to the spot price of copper on those. And so 0.35 is great for a copper oxide deposit. And we think that there are going to be zones that are above 1% within this deposit. And so finding more of that material is going to be key.
Okay. Look, Rick, I want to wrap it up there. And to recap, we're looking for the companies that provide the opportunity to stand in front of an avalanche, right? That's what retail investors want. We want to get in front of the avalanche. And we've seen the copper price surge. So the reason I like Barksdale is initially for the optionality. When we sat down, when I first met, I was struck by how non-promotional you were. You got right down to the details of what you were planning to do with Barksdale. And now you're doing it. So you've not only consolidated Sunnyside, which was the ambition, have the largest land package in the district. You referred to it as the powder keg. I hope you're right. But in the near term, we can look south towards San Javier, and as soon as July, hopefully have drills spinning in the ground. So lots of news to come, and lots to look forward to. So I like where this is right now. And I think that lots could change in the next 6 months. So lots to look forward to. Rick, thanks for coming back on, man. It's good to see you again.
Yeah, of course, Jay. Thanks for having me. It's always fun to be on your program.
Good. And the ticker is BRO for anybody who's looking. Did I get that? Is there an American? What's the American? BRKCF trading in the US. BRKCF, BRO in Canada. All right. Thanks again, Rick.
Thanks, Jay. Appreciate it.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Jamie Keech, the founder of Resource Insider and a partner at Inventa Capital. Jamie, it's good to see you.
Jay, thanks for having me back on. I was thinking it's been a little while. I think it's the better part of a year, so I'm excited to be here.
Yes, well, I want to pick your brain. I've got a handful of topics I want to jump into today. Determine where you're looking for opportunity, where you place capital, what you think is overpriced, get into your investment philosophy, a whole ton of stuff. So why don't we start with the macro environment a little bit? 2020 finished so hot, especially last spring, right? About a year ago, right? 2021 was very sleepy until relatively recently. And now we've seen gold begin to rally a little bit and a number of things start to fire on the macro front. So what's catching your eye right now, Jamie? What are you watching right now that you think investors should be paying attention to?
In terms of the macro front, I mean, the number one thing that we're paying attention to, which I think, everyone's talking about, it's not new, it's not novel, but what's going on with inflation. And the fact that inflation is being considered a reality for the first time in decades. And no doubt you've had other guests on here talking about this, but it's nowhere more apparent than things like lumber prices, which are up 3, 4, 5 times depending on where you're living. My analyst that works for me, for example, his mother is building a house in Pittsburgh, and the quote she got went up 20% in 6 weeks and they're actually replacing lumber with steel beams in part of this house. And so that's a little bit anecdotal, but it shows you what's going on and how fast that's actually happening. So obviously the impact of inflation is something we're really paying attention to right now. And, we've seen that massively reflected across the commodities basket. And we're starting to see that reflected in gold, I think, for the first time so far.
Yeah, I think you're right. And you know what, I've shared on this channel, a very similar example to what you just shared. I'm building a shed behind my house right now. And I was going to build it last summer. And the boards that I wanted from Home Depot were about like $32 per board. And they're $76 this year. Right, 1 year later. And so, we touch that number. It's very real. We feel inflation immediately. But the number one debate on my channel last year, Jamie, was the inflationists versus the deflationists. And have you put any thought into that? Or is it first, let me hit you with that first. Do you put any weight on the deflation argument?
Well, what is the case for the deflation argument? Because I don't actually see that. I see inflation having been a pretty real thing for a long time now, right? Because we've seen everything that can't be easily exported has inflated massively over the last 20 years. Living here in Vancouver, obviously housing prices being the number one thing we notice. If you're in the United States, you see healthcare. If you're in the United States, you see education in a big way. All these things that we can't easily export overseas are inflating. But now, for the first time, and I think in a large part because of COVID, we're seeing this start to trickle down to consumer goods, right? So I don't see a strong case for deflation, but I'd be curious to hear that argument.
Well, and the more I dive into it with my deflationary guests, I'd call them, is that it's not necessarily a this versus that argument as much as I believe it's a this, then that argument. And the deflationary arguments are largely driven by the exponential growth of technology. Albeit deflation hits us in more subtle ways, right? The price of lumber hits my wallet. I feel that impact. I believe in inflation because it's immediate, right? And it hurts. Whereas, I think about the price I pay for things like music compared to what I paid for music 10 years ago, $20 for a CD versus $7 a month for more than I could ever consume today. And that's the slow creep of deflationary technology, right? Eating that part of my life. Yeah. I think the deflationist argument when it gets into bigger consumer goods like lumber, and this is more conceptual and speculative, is once Home Depot can print my boards out of composite just down the road, and we're not worried about supply chains and logistics, that's when it hits goods like that as well. That's my understanding anyways.
Yeah, I mean, I think that makes sense, but I think it's kind of irrelevant in the grander scheme of things, right? I mean, the $20 CD is nice to have, or rather the $7 sort of Spotify membership is nice to have versus the $20 CD. But I think we're going to actually see real inflation in the things that actually matter for our lives. Things like construction materials, things like food. Another friend of mine, his father owns a grocery store and they're upping all their prices right now. And so I don't really see technology massively changing the price of food in the near term future, right? And obviously there's all sorts of efficiencies that can be created in farming and supply chains and stuff like that. But if anything, COVID has taken a huge hit out of like the efficiency of supply chains in the world. And I guess you can make the case that in a post-COVID world, there's going to be a flood of capital coming in. Everything's going to go back to normal. Supply chains are going to open up, et cetera, et cetera, et cetera. inflation might not be such an issue, but I actually don't see that happening. I think the next real step that we're going to be seeing is, increased resource nationalism. I think we're going to see countries turn inward. I'm not the first person to speak about this, but I think the era of globalization is kind of in decline, and the era of nationalization is starting. And countries are going to start prioritizing investment and control of their own asset. We've own assets in their own commodities, and we've seen that in the U.S. Already with things like uranium. We're seeing that heavily in places like Chile, even right now, historically in lithium. So I think this is going to be a bigger and bigger trend. And I think inflation is going to be a real problem in the things that matter. And by matter, I mean the things that we need and the things that are actually expensive.
Okay, so I agree with you on both those 2 points. Dialing it back to inflation, and then I want to get into resource nationalization, because that's very important. We'll talk about that. When it comes to the inflation play, Jamie, how does that impact your investment philosophy and how you're allocating capital?
So Resource Insider, it was birthed really on an inflation play. The things we're talking about now are things we've been talking about for 3 years. So my partner at Resource Insider, a gentleman named Chris McIntosh, the founder of Capitalist Exploits. Capitalist Exploits is a blog and an investment firm focused solely on macro investing. And Chris was had very strong opinions on these things for the last several years. He saw a lot of what was coming, probably 4 or 5 years ago. And he knew that he wanted to be focused on commodities. He wanted to be focused on real hard assets to counteract against inflation, to counteract against global debt, to counteract against resource nationalism. But he didn't know how to execute on it. He's not a mining person. He's not an energy person. He needed someone who could actually go out and do deals, acquire assets, get things done. And so we partnered, where my job was to execute and his job was the macro theme. So I've learned a tremendous amount from him on macroeconomics. He's been consistently right, even when I was sure he was going to be wrong. And I've started to buy in and really drink the Kool-Aid. But my job in my investment thesis, or how I'm executing the investment thesis, is what do we go after and how do we go after it to really execute on this idea and protect our wealth and actually put it in a position where we can grow it in what I think is going to become a really challenging environment for the world. And Jay, and some of your listeners will know, at Resource Insider, we're focused on the mining space primarily. And what we do is private placements and deals in the sector. So I go out and I talk to companies across the sector, across the commodities, and I look for good investment opportunities. I put my own money in, and our members get to invest alongside us. So where we've focused over the last 3 years that we've been doing this, we've done it in uranium. So we've built a big portfolio of uranium stocks, which is up about 180% right now. We've got lots of assets that are gold, lots of gold assets. And then, of course, we've got copper. We're working on nickel. We've got some lithium. But we're really, really trying to build a diverse sort of metals and mining portfolio.
Okay, so let's zero in on copper for a little bit, because I would like that to be the focus for today. We've got a ton of inquiries from my audience asking questions like, what's different about investing in copper from investing in gold, right? And I gravitate towards things like, well, the exit strategy for one, right? If you're a gold developer, you've got an economic asset, you've got a number of exit strategies, hundreds of suitors that might be looking for an acquisition. You could raise the capital and build the mine yourself. That does not apply in the copper space. But what advice would you have, Jamie, for a retail investor who's got a few years under their belt speculating in the gold space, and now they're trying to allocate capital to the copper sector?
So I would say the number one thing you should be aware of, and anyone who's spent any time looking at this is probably already aware of, is that there's way, way fewer options in the copper space available to you as an investor. So if we look at the TSXV, where you see most of these junior companies listed, it's something like, and I'm not going to get these numbers exactly right, but it's something like 70% of all mining companies on there are junior. Or what am I trying to say? 70% of all junior mining companies on there are gold.
Yeah.
And then like the next 20% are copper. And then the last 10% is like pretty much everything else, be it iron ore, be it nickel, be it lithium, whatever. So copper is, a fraction of the size of gold. So there's less names in there that are available to choose from. In some ways, in some ways, that's a good thing because there's less shitty names in there. And, gold seems to me to have this particular ability to attract the hucksters that copper doesn't quite have. And I think a big part of the reason for that is copper doesn't have quite the sex appeal to the average person as gold. And it tends to be, I think you were alluding to this, it's more for the serious mining people and it's more for the serious mining companies. So, to your point, if we can elaborate on that, the exit strategies are different. Well, the reason the exit strategies are different is because copper exploration and copper mining tends to be way, way, way more expensive, way more capital intensive than a gold mining project, right? So to put a copper mine into production, it's not unusual to see 2-3+ billion dollar market caps, where often you can put gold mines into production for sub $100 million. Now, if I have a $100 million exploration company, it's not that hard for me to raise an extra $100 million to put it into production. If I've got a $100 million copper exploration company, the idea of bringing in $3 billion of financing it's unforeseeable. It's impossible. It would destroy the company. So your only option is to sell it to a major. So if you look around, there's very, very few copper mid-tier miners, right? I can think of Eros Copper as a good example in Brazil. You might have been able to call Turquoise Hill in Mongolia, Robert Friedland's deal. But I mean, the operator now is Rio Tinto. It's a $4 billion company. But these are sort of the startup stages of copper assets right now. Whereas you can really get a wide basket of gold, mid-tier and small scale or small single asset miners. So your playing field is really, really different. The good news is, the winners quite clearly stand out. But the early stage stuff, the exploration, I would say you're actually taking on, a much more significant level of risk there because one, you have to make a discovery. And two, even if you make a discovery, which is, far from certain, it has to be a discovery that the company can advance. It's possible to make a discovery that is so far out of the depth of what a company that size can do with that it hurts the share structure, it limits the access to capital, it puts them in a position where they're not able to bring the project forward, and it's reflected in the value for shareholders.
So therefore, what do you need to see? Do you need to see a period of work done, years invested before you'll get involved, Jamie, with your wallet? What do you need to see before you'll take a company seriously?
Well, let me tell you in a couple of stories of what we have done. So I think the very first thing investors want to be thinking about is what is the value add catalyst that they're investing for? So looking at copper deals, we just invested in a massive, massive copper project in Latin America. It's a private deal right now. I can't even say the name of it. We just finished the investment this week, but we're investing alongside three of the biggest mining companies in the world, the biggest mining private equity fund in the world, big New York hedge fund. They've got 15, 20 million bucks in the bank, but it's in an area that has historically been hard to permit. And for reasons I won't get into right now, I believe they're going to get their permits. I believe they're going to be drilling soon. And I believe when they drill, they're going to be a listed company. So the reason that I'm investing here is because I want to see them permitted, I want to see them drilling, and I want to see them listed. That will be a huge value creation catalyst for investors that got in before those things happen. And I anticipate seeing this company listed and going next year. I anticipate that we're going to make 3 or 4x the money we put in at that point. Now, will they make a discovery there? I don't know. It remains to be seen. If they make a discovery, will there be a mine there? I don't know. Remains to be seen. If they find a mine, will they be able to permit it and put it into production? I don't know. It remains to be seen. But none of those things actually matter for me. I'm investing because I believe politically the time is ripe for them to get permitted. I believe they're going to get drilling. I believe they're going to list, and that's going to create value for me. So I think it's very important that investors kind of know why they're investing. Don't invest in a deal like this because you want to see a producing copper mine. You know what I mean? Another example of a company we've invested in is Meridian Mining. They are public. We invested in them at 20 cents. And this is the perfect perfect copper deal. Because when we looked at this company, I'm going to blank on what the market cap was at that point. I want to say it was like $20 million, but I don't think that's exactly right. It was 20 cents, what they were trading at. A small junior company had acquired a project that had the shit drilled out of it by Rio Tinto, okay? And they'd had something like $100 million of drilling and infrastructure and work put into this deal. And we were able to invest in it for something like $20 million. So when I look at that, I'm like, well, you're inheriting $100 million of work pretty much for free. The exploration and capital costs associated with that are going to be far, far decreased to what it would be if it was a grassroots program. Additionally, they have tons and tons and tons and tons of data. So what they're doing now is confirmatory drilling. So they're going in and they're sinking, one hole for every 10 holes that already exist. And they're saying, yeah, the data matches. This is correct. We can assume this is right. On to the next. And they're able to very quickly, very cost effectively build out a resource. So what I'm investing for here is a quick, cheap, easy resource that they're going to say, look, there is copper here. There's this much copper here. Hopefully there's more than we thought. And it's going to see a re-rating of the value of that company. We thought there was this much copper. Turns out there's that much copper. It's worth a lot more. Since we've invested, they hit like 80 cents this week. So we're up, quite a bit on this. We had a full warrant or maybe half warrant on this one. So it's been a tremendous return for me and for members of Resource Insider since I want to say it was early December last year that we came into this. And these are sort of the unique opportunities in the copper space that I look for. So that's the deal side. That's going out with Resource Insider, finding these deals. If I'm a normal, non-obsessive, compulsive mining investor, and I'm sitting at home and I think I'm looking for copper exposure, then I'm gonna take a very different tact than this. I'm gonna say, well, I should probably own Freeport McMoRan. It's probably the biggest copper miner in the world. They've got operations all over the world. If I'm just looking for leverage to copper price, hard to do better than that.
Okay.
I'm going to probably also buy a Turquoise Hill, right? One of the best copper mines in the world, operating in Mongolia, discovered by Robert Friedland, one of the best explorers in history, operated by Rio Tinto, one of the best operators in history, $4 billion market cap, single asset. It's going to get taken out by Rio Tinto at some point. That's the obvious sort of future of this thing. So that's a single tier one. And then, I'd probably buy Nova Royalty, right? It's the only copper royalty company I've ever seen, or at least that I know about. They don't have any producing streams or royalties at this point. They're probably a little expensive, but royalty companies tend to trade at a premium. They're doing great work there. That would be my kind of riskier bet if I were just, if I'm a dentist sitting at home in Missouri and I think I want copper exposure, that's kind of how I would play it. And then honestly, I would listen to me talking right now and I would probably go buy Meridian Mining because I think that thing's going to be a lot bigger. I think it's going to be a multi-dollar stock over the coming years. I would take those, share certificates. I would sort of stick them under my mattress and I would just forget about it for a couple of years and come back because I think all these things are going to be in a much, much better position. I truly think we're in for like a generational copper market on this one.
I love it, man. Okay, so thank you for that. And a couple names never hurts. Myself and my audience love that. So
I should say this is not investment advice, I guess, from something like that.
This thing on my channel.
So this is what I would do in that situation.
Yeah. No, appreciate the clarity. And all I do here is talk about what I'm doing, what I'm looking at. And exactly, I don't recommend anybody follows me down any of these rabbit holes. But I appreciate your insight, Jamie. So looking at the US right now, any companies stand out that you think, or you're curious about, you think investors should take a look at, you think have asymmetric upside promise?
So looking at the US.
Any jurisdictions in the US, yeah.
Copper companies?
Correct.
I don't know. I don't own any US copper companies, to be honest.
Okay.
And I don't have any. So I own Meridian Mining. That's in Brazil. Awesome. I own Solaris Resources. That's in Ecuador. Also going awesome. And this just goes to the exponential return potential of these mining stocks. I bought Solaris Copper at 50 cents. 50 cents. It's at $11 right now. Okay. And where else do you see these returns? And I kind of like laugh at Bitcoin when people are like, oh, Bitcoin went up 10x in 1 year. Like that's a 12x and that's just one deal. And you get these opportunities in mining and you get them, so few other places in the world, maybe tech investing, but in mining investing, these deals list on public exchanges. You're not locked up for the next 10 years. I can sell any of these stocks right now. It's an amazing opportunity. And then I'm also in, Surge Copper, which is a BC focused exploration company. They've got a resource. They're searching porphyry projects. They're right next to a historic copper mine. I think British Columbia is going to be like the Chile of the future in terms of copper production.
Interesting. Okay. And we hope in the good sense of discovery, not in the recent
not in the recent sense of a hard lean left and a nationalization of assets. Why I think that is. Now, historically, BC porphyry coppers are considered relatively low grade, and they are low grade with respect to what we were finding in Chile historically. But, the whole narrative in the world right now is this push towards ESG, right? Environmental, social, governance, doing things in a green way, doing things that reduce carbon footprint, right? Now, companies, I think we're seeing the most progressive companies like Apple, for example, have very stringent guidelines on their supply chain management. Where does their cobalt come from? Was it, mined by child miners in the Congo? That's obviously not something they want, but I think this is going to be something we see more of, that the supply chain becomes very, very important. And when you look at British Columbia, first and foremost, something like 95% of all power produced here is hydroelectric power, right? It's the cleanest energy in the world. So how do most of these copper projects around the world that are getting mined by burning oil and gas, by burning coal, compete with the, green and cleanliness of British Columbia copper? Secondly, we're meeting, the highest international environmental standards, social standards, engaging with Indigenous people in respectful, responsible, sustainable ways. So I think BC, it's got a plethora of copper deposits here, and we're just about to enter like the golden age of mining and exploring these things.
I'm with you. Yeah. Okay. And, to your point about resource nationalization, that's why I asked about the U.S. I just feel like any national supply of any commodity is going to be a priority.
Yeah. And, but I think Canada and the U.S. are going to be very linked on that. The U.S. is the manufacturing hub, and Canada really is the supply hub of those materials. Okay.
Yeah. And, somewhat of a leading question, because I'm also chatting with Rick Trotman, a CEO that I follow. Barksdale.
Oh yeah, I own that deal too. I forgot. So I do own one U.S. copper deal. Rick, I'm sorry because I am excited about everything they're doing there now.
Yeah. Okay. So this is Barksdale in Arizona. Recently consolidated that district. Interesting. Okay. Oh, you are a shareholder. Interesting. Okay.
So I am a shareholder. All Resource Insider members are a shareholder too, or not all Resource Insider members. All Resource Insider members had the opportunity to become shareholders. It's such a cool project because we invested in that at 38 cents with a half warrant. It's the cheapest financing they'd ever done. They'd been at this thing for years, right? They're basically holding on, waiting for permits to properly drill these projects. And they believe this is the extension of the Taylor deposit, which is part of Arizona Mining, which got bought by South 32 for, I don't remember how many billions of dollars, but a lot of them. And so the idea is if they ever get drills turning on this thing, from the geological evidence we have so far, it's very indicative that deposit carries over onto Barksdale's property. It can be much, much bigger. It could be worth, exponentially more than what it is right now. So we invested in it in a bit of a doldrum time. It's done tremendously well since then. They just had news, I believe it was early this week or last week, that they executed upon their option. They now own 100% of the project. Originally, I think they were on track to own 66%. So it's way, way more valuable. And the market hasn't barely woken up to that fact yet. And this is the kind of project where whether it's it's going to be probably this year, knock on wood, when they sink a drill hole in that damn thing and they prove that thing extends, this has 10x return potential written all over it.
I love it. Okay, Jamie, look, it's been great having you on. I love your energy, man. And And you talk your book, which I appreciate. You tell us exactly where you've put capital, where you've got skin in the game, which I appreciate. My audience appreciates. So thanks for making the time.
Well, I think that's important to do, because the reason we do it is because Resource Insider, it's private deals when we do it, or they're pipe deals. But we want to tell people, what we've been doing after it's done, because we don't sell a stock picking newsletter. I'm not hoarding information. We put our own money into deals that we think are going places, and we tend to hold stock for significant periods of time. And so, anyone of your audience, if they want to see our entire portfolio, they can send me an email at jamie@resourceinsider.com, and I will show them every trade we've ever made from inception in the entire, history of our newsletter. And I don't think we have any competitors that would do something like that, because, we're up 160 something % right now. I'll show you the good, the bad, and the ugly, everything we've ever done. So yeah, please send me an email.
Love it, man. Okay. Appreciate that. Thanks again, Jamie.
All right. Thanks for having me on.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I am joined right now by an exciting new copper opportunity. And one of my guests is familiar, Mr. Mark O'Day, the executive chairman of Northwest Copper. He's been on the show several times with Pure Gold. And I'd like to welcome Peter Bell, the president of Northwest Copper, to the show for the first time. It's great to see you both.
Hey, Jay, good to be here again.
Okay, well, I'm excited to jump into this, and there's a handful of buckets that I want to talk about when it comes to this story, because there's lots going on. I think timing's excellent. I'm very curious about, we'll start with you, Mark. This is the merger, right? This is what Northwest is. It's the merger of Sun Metals and Serengeti Resources in British Columbia, Canada. And so I want to start there with what struck you about this merger and why you decided to execute on this right now.
Well, we can start thematically. So thematically, copper is having its day in the sun. From a supply demand side of things, the supply side's down, it's under pressure. The demand side of things is growing, driven by a whole bunch of things globally, including, the whole sort of clean energy movement, but just the general modernization of economies and countries, et cetera. So that isn't slowing down, and it's creating a huge opportunity for mining companies that are focused on copper. So thematically, that's important. We think we got the timing right for the merger. And, the other theme that we always focus on is location. So good projects in good places has been our mantra for the past 20 years. And BC is definitely emerging, or has emerged, as a fantastic place to look for, mine, develop copper gold projects in the North American setting. So what we put together here at Northwest is a combination of two, what were previously essentially single asset companies. They had a bit of a pipeline behind them, but on a combined basis, we've created a fully diversified, BC focused, tier one focused, copper gold explorer developer that provides a whole bunch of additional optionality and excitement combined than either company really provided on their own. So, we think this is synergy at work, right? This is truly, the whole is greater than the sum of the parts here. And we're giving investors an opportunity to win on a bunch of different projects that range from early stage grassroots discoveries that, projects that have never been drilled before, like East Niv, that have big outcropping ore grade mineralization, to much more advanced projects like the combined Stardust and Quenica asset that really underpins the value of the company on a pounds and ounces in the ground basis.
Okay. And, just for context, I talk so frequently on this show about following the best people, and you touched on your 20-year track record. You've delivered on this narrative, exploration through to development and operation in the gold sector, in the silver sector. Here we are in the copper space. And everybody who watches my channel is pretty up to speed on the high level macro trends that are fueling all the, I guess, well, the demand. I mean, the supply demand economics have probably never looked better, never in my lifetime anyways. Peter, I want to move to you because I'm really curious about what struck your attention. A little bit about Peter's background, over a decade at Newmont Corporation, 10 years managing money in London, 3 years at National Bank in Toronto. You've looked at thousands of mining deals in your career, and a number of marks, as you guys shared before I hit record. And so, why did you jump now? What about this opportunity convinced you that this is the one I'm going to change my career for?
Sure, great question. So there are a few things, as you might imagine, and one of them obviously is the opportunity to work with a group that's got a great track record. So working with Mark was kind of a no-brainer part of the whole thing. In terms of the timing, the copper macro is very supportive. There's a lot of tailwinds behind the copper price, but also just thinking about copper development stories, we in banking, and certainly when I was on the buy side, were always aware of the limited number of copper development stories. And unlike the gold space, there are lots of them in gold. There are many fewer in copper for lots of reasons. And one of them is that copper projects, most of them are kind of big company games. So they require a lot more money than small companies can generally put together. So a lot of companies make a big discovery and they end up with a project that's much bigger than what they could possibly build. And then that puts the shareholders and the management in a bit of a bind, because all you can do is keep studying it and hope that someone buys you. So one of the things that was drilled into me when I was on the buy side by my partner there, a guy called Mike Humphreys at Polygon, was always make sure you've got multiple ways to make money in an investment. And if you're in a company like this one, the opportunity here comes from obviously growing the company and hoping for a takeout. That's a great outcome. But here, because we got the high grade from Stardust, so Stardust is 5 times higher than the average BC copper deposit in terms of grade, and the higher grade part of Quinnica, when you put those together, you have an opportunity to scale a project to a level that we could actually finance and build ourselves. So we've got a second exit there, and that is hugely powerful. It's powerful from a takeout angle. It's powerful from a build and kind of realize that cash flow at some point, but it puts us in control. And that ability to control the outcome was one of the major things that attracted me to coming and joining the group.
Yeah, I think that's such an important thing to hear from the CEO at the jump in a copper story, because so frequently I'll speak with retail investors who are looking at copper stories with the same lens that they look at gold stories. And you touched on so many important points regarding why that's a mistake. Namely, the exit strategies are just far more limited, right? You've got an economic gold deposit. There's hundreds of suitors that might look at you as an acquisition from small caps, mid-tiers, and majors. Alternatively, it's feasible that you could raise the cash and build the mine yourself. In the copper business, that's far less likely. And what is there? Maybe half a dozen suitors that would actually look seriously for acquisitions.
Yeah. Yeah, so it's it's been a buyer's market even in a limited a supply constrained kind of time, because first of all, when you buy these things, that can be expensive, but then whoever the acquirer is then has to come up with billions of dollars to put it into production, and that scares people away, quite frankly.
Right. And so, we always hear the same 3 things when I call them like the investment gurus that I have on this show, the Warren Irwins, the Rick Rules, whoever you want to call out. When you're looking at copper, what do you look for? And it's always scale, grade, and an angle, right? And so we touched on the angle a little bit. You also touched on grade. And so I want to dive into that a bit further because it is notable. As you said, 5 times higher. It's the Stardust deposit that came from Sun Metals, 5 times higher than the average copper grade in British Columbia. So catch my audience up to speed on the deposits, Stardust and Quinnica, which are the gems we're going to start with Northwest.
Sure. So Stardust is a carbonate replacement deposit. It's a structurally controlled deposit, so narrower, a little bit smaller, massive sulfide with very high grade, good continuity. it's an underground mine. This is beautifully set up for underground mining, for long hole stoping, very simple, straightforward mining method. So this, this deposit is kind of, as from a mining point of view, from an underground mining point of view, incredibly straightforward. And that grade, sweetens the copper production and the cash flow in the future. And that combination of that grade with the scale of what Quinnica has really makes for a unique and interesting combination, because, there are high grade deposits around, but they tend not to sit right next to a big porphyry copper gold deposit. We're talking 7 kilometers away. So it's incredible that nature allowed, those two deposits to be as close together as they are. If you look at Quinnica is a pretty interesting deposit in its own right. So it's got, a few 100 million tons of kind of typical BC grades, but at the same time, it's got a very distinct high grade zone that can be mined separately or on its own if that's the way that we choose to proceed. And its geometry is such that high grade is early in the mine life. So any potential mine life we would be able to get to that higher grade very early on. So, talking about the angle, the angle here is this is a copper deposit, copper gold deposit that has a cash flow profile that's more like a gold deposit. So it's, you get your money back sooner, it costs less to build, and, you don't wait around for years and years and years to get the payback. So it's a pretty unique combination of deposits.
And just to quantify a little bit on the grade, we just published a resource on Stardust. So we, post-merger, 2 of the deliverables that we said we were going to serve up to the world was a first metallurgical study on Stardust and a first ever sort of holistic resource on Stardust. So the MET came out incredibly positive, well in the sort of low to high 90s on both copper and gold. So very, very metallurgically favorable. And the resource that we just published came in just under, in all categories, just under 8 million tons, sort of 8 million tons of 2% copper equivalent. So we're talking, the world is awash with, 0.3 to 0.5 copper deposits. And we're looking at a deposit here, a massive sulfide copper gold deposit that's running 2% copper equivalent with much, much higher domains within that sort of 2% equivalent envelope. And Quinnica is sitting right next door, as Peter described, that in and of itself has got amazing zones of continuity that are running hundreds of meters of well north of 1% copper equivalent. So very peculiar and unusual for a BC porphyry is this high-grade core, but it lends itself to a beautiful combination with the high-grade Stardust deposit right next door. So we think we're very uniquely positioned to demonstrate what this synergy looks like when you combine these 2 high-grade centers right next to each other into a combined development project.
And just to be clear, I just want, because I know I present this quite often. It's the idea is to have one central processing plant and have both projects feed into that central plant. So that's the scenario that applies to the 2 deposits.
Okay. Now, I know one question that I'm going to get, given this project is in British Columbia, Canada, is community partnerships and ESG initiatives. Now, Mark, I'll pass it back to you because you've been doing this enough times. You've been through this with a handful of companies. So can you touch on any initiatives that you're undertaking right now with Northwest?
So both sides of the merger came to the table with really good working relationships with the First Nation groups that were in their respective project areas. And in the case of Sun Metals and Quinnica, that is the Takla First Nation. So we have an exploration agreement in place to allow us to sort of work together and move forward and do the exploration work this year as needed. So I think both sides of the merger did a fantastic job of building community support and First Nation dialogue and agreements. So that's looking really good. And then at East Niv, we've got agreements in place as well there to conduct the 3,000 or 4,000 meters of drilling that we've got planned for that first ever drill program on that exciting new target for the summer. So we're very well positioned from an agreement point of view for this year.
Okay, thank you. Now you touched on it briefly, and I'll go to whichever Peter or Mark wants to touch on the drilling program. When we're looking at upcoming news flow, I know you're cashed up, deploying about $10 million into the ground this summer. Correct me if I'm off the mark on that. But what can we expect in terms of news flow here?
So we will start the drilling at Quinnica imminently. So we're basically ready to go anytime there. So that's this month and ASAP. And that will continue for most of the year. So we have a mix of near mine targets and actually kind of in mine, in project kind of enhancement drilling within Quinnica, and then a bunch of satellite targets there. So that will be ongoing. And then East Niv is helicopter supported. So although it's close to infrastructure, there's not a road into there. So we have to fly in. That project will be, the drilling itself would be from the beginning part of July until probably sometime in October. And then news flow, assays and so on following that.
Okay. Look, I want to thank you both for introducing the story. Any last words you would like to leave my audience with before we sign off today?
Peter, you want to go first?
I really like your comments about what is important in a copper investment, and I think we touch all those things. I think this project actually, by virtue of the grade and the scale of the two, it actually provides scale. There's actually opportunity for pretty material production here, but the angle again is that combination of opportunities to realize value here, and to me that's the most important and most differentiating part of this story versus many other quite quality stories.
I'm glad you brought that up, because optionality is a key ingredient that we always look for in companies at this stage. Yeah. Mark, anything to add?
The only thing I'd add really is to circle back to something I said at the beginning, which is, this is a lot more than just a development stage project. This is a combination that has put together a true pipeline that spans the whole spectrum of the mining continuum. So you've got all of the excitement and momentum of a new discovery potential at Niv. And if we tag into something there, in our first round of drilling, all bets are off. It's going to be a huge momentum driver for the company. And all that is happening while a project that's a lot more mature is getting de-risked and sort of moved up the development curve closer and closer to production or some kind of decision in that direction. So we hope by the end of the year on Stardust and Quinnica to provide a PEA level piece of work that can demonstrate what that combined project is capable of delivering.
Okay. Yeah. Okay, so we've got news to look forward to in the near term. Thank you both for coming on. I want to check in again midsummer and get you back in front of our audience and touch base and peek behind the kimono again. But thank you both for your time. I appreciate you both coming on.
Thanks, Jay. It was
Thanks,
great.
Jay.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I am joined once again by the former CEO of Sprott Resource Corp, and now the CEO of Rick Rule Investment Corp, Rule Research, investor speculator, many other things. Frequent guest on my show. Rick, it's great to see you.
Always a pleasure to be with you, Jay. Thank you for having me back.
So I have a bucket of topics I'm looking forward to jumping in to with you today. What I thought I'd like to start is a statement that I've been hearing a lot on my channel and then more recently in headlines elsewhere, but I'll turn it on its head and put it to you in the form of a question, Rick. Is copper the new oil?
No, I don't think so. I think they're separate asset classes. Clearly, the common narrative is that the electric car will replace the internal combustion engine, and that will happen in 2040 or 2045. Oil is the new oil. We burn between 90 and 100 million barrels a day of the stuff. Until fairly recently, we were making it for $60 a barrel, selling it for $30 a barrel, losing $30 a barrel 100 million times a day, which is to say $3 billion a day, and trying to make it up on volume. Oil is the new oil. The internal combustion engine still represents the most efficient mode of transportation in the world. And there are many places in the world that are not Vancouver, which is to say there are many people in the world that have no prospect of owning a Tesla, but do have a prospect of owning a Toyota Hilux pickup truck.
Yeah.
Copper, however, has attractions of its own. Not so much the narrative that you hear today, Jay, that revolves around electric cars and so-called distributed power, which is a fancy way of saying batteries.
Yeah.
But rather the ascent of humankind, the 1.2 billion people in the world that don't have access to electricity, but will over the next 10 years. And it isn't just the wire that gets to their houses. It's what they do with the electricity once they get it. The circuitry in the houses and even the distribution of electricity in internal combustion engines. So copper doesn't need to be the new oil. Oil is the new oil. Copper is the new copper. Importantly, Jay, with regards to copper, society hasn't spent enough money looking for and developing copper for 30 years. We're living off deposits that are your age, which is to say, no offense, but long of tooth, not as long of tooth as I am, of course. But the point is that almost no matter what we do, almost no matter what demand looks like 5 years from now, we're going to begin to have supply shortages of copper because the great copper mines in the world, Escondida, Grasberg, Bingham, are long of tooth.
Yeah.
It's important to note, too, that the greatest copper producer on the planet, Chile, is striving mightily to snatch defeat from the jaws of victory. It is copper that has made Chile great. It is the growth of the copper industry that's made Chile great. And the government now is looking to steal 65% of the revenue from the copper business. So at precisely the point in time when the Chilean government should be looking to expand output, they're looking to choke off output and increase margin. So the future is very bright for copper, but not for the reasons that many of your listeners believe.
Yeah. You know, it's funny. I recently spoke with Warren Irwin, who gave me a very similar response, kind of laughed in the face of that question and said, absolutely not. His answer was a bit different in that he said, no, copper is the pipeline and uranium is the new oil. Now, he's not talking about internal combustion engines, more grid power and whatnot. I know you're a uranium bull, so I want to just quickly touch base with you there, Rick. Where are we at right now in the uranium cycle?
With the caveat that the junior uranium stocks are grievously overpriced at today's uranium prices. I believe, like Warren does, and for the same reasons, that the uranium price over the next 5 years should double. We're beginning to see the term market increase. It's important to note for most of your listeners that the price that they pay attention to in uranium is the spot price, where about 25% of total volumes take place. The term market is much more opaque, but 75% of the uranium trades there. As the term market expands, what I think that you will see is a much firmer tone in the uranium market. That said, I'm concerned about the fact that the uranium juniors have uniformly tripled in a market where the spot price hasn't moved very much at all. It could be that speculators are correctly anticipating a near-term move in the uranium price. I can't say that for sure. I would only say that I agree completely with Warren's thesis about a bright future for uranium. The only caveat is, as I say, the penny dreadfuls, the junior uranium stocks are uniformly ahead of themselves based on today's uranium price.
Right. It's almost as if they respond more to Twitter comments than the uranium price.
I don't know if you remember this, Jay, but we talked about uranium stocks 9 months ago. And what I did mention to you is that there's a lot of old, fat, rich speculators. You're looking at one who experienced the last uranium bull market. And we're anxious not to miss this one.
Sure.
So any hint that we get to get involved, we get involved. And the market capitalization, the total market capitalization of the space is so small that any change in narrative drives the price. You may remember back to 2016 when the same thing happened. We had a melt up in uranium stocks, short-lived, and for no reason I can think of, but the uranium juniors all uniformly tripled then too. It's just a very, very volatile sector.
Yeah, it's interesting. I can relate to what you're saying there only in the So I think of the content at our shows back when we were doing live events up until last March, so 14 or so months ago. And it didn't matter what the uranium price is doing. If we did any content on the uranium market, it was like people were tearing down the curtains trying to get in the room to hear whatever was being said. It's like, I hate to use the analogy silver bugs on steroids, but it's kind of like silver bugs on steroids. It's amazing. Okay, so dialing it back to copper, though, interesting comment about the Chilean government looking for a 65% cut. Now, political risk has been more of a conversation on this channel. It comes up more and more frequently in the last year. And so where are we safe to look, Rick? First of all, were you surprised by that? Are you surprised by that activity in Chile?
I shouldn't be. I am, because Chile has been so good to me.
Okay.
Chile has probably been the best jurisdiction in the world to me relative to capital in, capital out. And Chile has prospered so mightily with their halting attempts at free markets that it surprises me that the Chilean electorate is expressing as much stupidity as they are. That being said, there's a truism in politics. Those places that can't get worse don't, they get better. And those places that can't get better don't, they get worse. When the populace sees a goose that lays golden eggs, after a while they get tired of the eggs and they want to eat the goose.
Sure.
Doug Casey famously says it's bad enough as a taxpayer to be regarded as a milk cow. You have to be concerned when the government begins to regard you as beef. It's a very different proposition. And I think that, unfortunately, Chile is beginning to look at extractive industries as beef rather than milk. This is common. You weren't around for it, but in the decade of the 70s, which was a great decade for resources, lots of frontier and emerging markets did better than they had in previous times. And they uniformly squandered the opportunity by nationalizing their resource industries and running them into the ground, only to have to privatize them in 1990. I'm sure that there will be a swing away from sanity in Chile. And I'm sure, too, that there will ultimately be a swing back to sanity in Chile. But it might take 5 or 6 years.
Okay. Similar question when it comes to Argentina then, Rick, because I know you've invested with the Lundins extensively. That's like their hometown. So what are your thoughts?
It's a rough place. It really, truly is a rough place. Their national sport is stealing from foreigners. They've had, 7 sovereign defaults? The fact that Argentina could sell a 50-year bond, I guess it was a 100-year bond, just tells me how dumb bond buyers are these days. By the time that bond matures, the Argentines will have defaulted on it 5 times. What one needs to do is, if one's a speculator, one needs to speculate in Argentina after they deliver spectacularly bad news. They seem to do that every 2 or 3 years, so you don't have to wait long.
Sure.
The idea that you would invest in Argentina when it feels comfortable to you is setting yourself up for disappointment.
Interesting.
It's a very, very tough place. You know that many people don't know this. Argentina had a higher GDP per capita than Canada did in 1946, coming out of World War II. Okay. It took extraordinary talent to bankrupt that country. The Peronistas, which are the Latin equivalent of your NDP, exhibited almost a masterclass in how to ruin a prosperous society. But they did it.
Okay. Now, where else could we look? What about Peru?
Peru's getting worse too. Peru's had 10 years of prosperity, 12 years of prosperity. I guess they figure that's enough. I guess they figure that what they're going to do is tax their way back to the Stone Age.
Now, is that just a global trend, though? I mean,
it is.
Yeah. So where we look.
One of the things I like to say is that folks who look like you and I, now that I'm not with Sprott, I get to be politically incorrect again.
Right.
Folks that look like you and I equate political risk with places where people don't look like you and I. Specifically, people who look like you and I believe that money stolen from us by the legislature in English, according to the rule of law, is somehow less gone. I guarantee you that in Canada, you have seen the pre-election budget, which is the spend budget. Here, we buy your votes with your money. Yeah. After the election, we're going to see the pay budget, which is where envy comes in.
Yeah.
And you're going to see marginal tax rates in Canada that look Peruvian. So when you're talking about political risk, understand that political risk looks like you and me too. White people can steal from you in English according to the rule of law with at least equal proficiency than third world despots.
Right.
And we will see that on both sides of the 49th parallel.
Yeah, no doubt. No doubt. Well, okay. Another CEO I'm speaking to right now is Mark O'Day and Peter Bell with Northwest Copper, local in my neighborhood, British Columbia, Canada. You could say it's more predictable in a sense, but maybe that gets back to what you just shared. It's all a matter of context.
I completely disagree. I think the NDP believes that they need to carry some rural ridings.
Okay.
And so they've spoken kindly of the copper industry.
Yeah.
The mining industry. I think the only safe place in British Columbia to invest is in the far northwest, in Tahltan territory.
Interesting.
I think the First Nations people in northern BC have substantial political clout because they control those ridings politically. And I don't think the NDP can afford to disenfranchise the Aboriginals, Indigenous people. And the Indigenous people, the Tahltan, the Nishka, the Shkukum Laksha, are very much pro-mining because they have a stake. So the only part of British Columbia that I feel secure investing in is the Golden Triangle.
Interesting. Okay.
I believe, again, that places that can't get better don't. They get worse. I mean, one personal example in British Columbia, I'm a foreign property owner.
That's right.
They won't let me into my property, but they've doubled the vacant home tax. In other words, they prohibit me from using a place that would help me obviate the tax if they didn't prohibit me from using it. And since they know they have me trapped, they double the tax. In my experience as an investor in foreign jurisdictions, when the host government sends you the first warning shots, you're well advised to listen. And I'm listening to Vancouver, listening to British Columbia with my ears wide open. Yeah. I get it where it goes from here. Not pretty.
Okay. So then what strikes you as opportunity in the copper sector, Rick? Are you looking at individual companies? Are you looking at CEOs? Are you looking at countries? Where are you looking?
If you believe like me, and you believe that the government that is the closest to you is the greatest risk, you don't sort by geography, you sort by deposit, and you sort by people. My biggest recent win in the microcap space has obviously been Ivanhoe, where I was an early, loud, and proud adherent, including at your conferences. That's, from my point of view, the best copper discovery in 100 years. And it's fronted by Robert Friedland, who is the most successful mining financier of my generation. It's in a hard country, Congo.
Yeah.
But the truth is that I've been treated better in Congo in the last 20 years than I have in Canada, and certainly better than I have in California. So I'm deposit-centric and I'm people-centric, more than jurisdiction-centric, because I dislike all jurisdictions. If I could find a high-quality copper deposit, say in West Australia, a place that was dependent on mining and had a mining culture, I'd be real happy, but I'm fresh out of them. The number of deposit that ticks every box is 0.
Okay, so then crash course when looking at a deposit. You're one of my viewers right now, been a gold speculator for, let's say, just a few years, relatively new to the space. Had some success last spring, feeling really smart. Thankfully, you've got some cash in your pocket and you're looking at the copper sector. Give us, as simply as you can, Rick, what's the first diligence investors should begin to do on a copper deposit?
The deposit needs to have the ability to become a tier 1 deposit. A hot market will pay you for a lousy deposit, but lousy deposits have so many risks. I define a tier 1 deposit as recoverable in situ metal worth $10 billion or more. So the deposit has to have decent size. It also, relative to the size, has to have decent grades. What I have against BC porphyries is they're often too low grade to make them tier 1 deposits. A tier 1 deposit, in addition to having, from my point of view, needing to have $10 billion worth of in situ recoverable reserves, needs to be in the best quartile worldwide in terms of return on capital employed. The return on capital employed at current metals prices should exceed 25%. In addition, the deposit should be, at least in a pro forma sense, in the lowest cost quartile worldwide. So what a speculator needs to look at is not, as an example, a small high-grade mine, a bootstrap mine, but rather an exploration bet or a development bet that could become a tier one deposit. Tonnage, grade, it needs to tick a lot of boxes.
Okay.
I'm amenable to the mineralization in British Columbia because it's gold rich. Those porphyries have an unusually strong gold credit, which is the reason that Highland Valley, as an example, works. But the idea that you're going to discover too many more tier one deposits in the BC alkalic belt seems unlikely.
Okay. Now, based on that criteria, Rick, I want to try to peel some names out of you. If you think any companies are close, looking at something that could become that $10 billion or more recoverable asset, what are your thoughts? Anybody come to mind?
Yeah, I mean, I can find things wrong with every one of them.
Sure. That's all right.
Obviously, Ivanhoe, in their unexplored terrain, the terrain that they're not partners with Zijin, would probably be my top pick, although I'm, at its current market capitalization, it's not what I would describe as cheap, but it's the most prospective copper producer in the world.
Sure.
Similarly, I love the hole that Filo just hit, but it's at 5,000 feet in Argentina.
Yeah.
And it's a $700 or $800 million market cap, but I'm attracted to NGEX. I'm attracted to Filo, because both of those could be very, very, very large. I'm familiar with the fact that they're in a lousy country. I'm familiar with the fact that they're at 5,000 meters. They're very high, but they both have the potential of being tier one deposits.
Okay.
There is tiny Australian company by the unfortunate name Hot Chili, which has a big copper porphyry in Chile. It's grade challenged right now. Sort of 0.5% copper. But they've been getting very, very nice exploration results, and it has a much more modest market cap. So I'm attracted to it. I'm attracted to the exploration potential at Regulus, despite the fact that it's in Peru, where I see both politics and sociology deteriorating at a fairly rapid rate. I understand this hasn't happened yet, but I understand that there's a junior group which may get control of the great copper gold deposit in Pakistan, Reko Diq. That deposit defines political and social risk. Pakistan is a notoriously corrupt place. And, the Taliban tend to be a fairly unpleasant lot too. So you'd have to contend with both of those. The size of the prize, however, is incredible. I'm attracted to Entree Resources, which I think is Vancouver-based, that have part of the northern extension of the Oyu Tolgoi deposit in Mongolia.
Yeah.
Pretty clearly, Turquoise Hill will have to come after them eventually, provided that Sandstorm doesn't take them over first. So I'm attracted to that name.
Okay.
The common names that people are attracted to, the ones that are in places that you could mistakenly feel comfortable investing.
Sure.
Are, from my point of view, uniformly overpriced relative to the size of the resource and where they fit in economics against competitive deposits worldwide.
Right. Now, I have to ask, based on that comment, Rick, how much of that is a consequence of your ability to apply pressure and negotiate just based on who you are? I mean, can the average retail investor look at those prices the same way you do?
Right now, I don't have very much leverage because there's so much money in the system. Okay. My leverage over time has come from really three sources. I have a good reputation because I've been right mercifully more often than I've been wrong, or at least I've been right in larger size than I've been wrong. Mm-hmm. As a consequence of that, I have influence. And so I can bring investors. And I have a real willingness, maybe even a pathology for writing checks when nobody else writes checks.
Yeah.
So I'm very, very, very popular in bear markets. My joke, Jay, is that an old fat bald guy like me can win the 100 meter dash if I'm the only guy that shows up to run.
Right.
So I'm very, very popular in bear markets, but we're in a bull market. There's money everywhere. People are throwing money at metals that they can't pronounce, let alone spell. So the amount of moral suasion that I might have with an issuer is fairly low. Issuers, make no mistake, prefer dumb money. And for all my faults, I'm not dumb money.
Yeah, I have to agree with that. And I've heard you say that before. You want to be writing checks when they need you, not when you need them. And there's a lot of chasing going on right now.
It's insane right now.
Okay. So question for you then. Commodities in general, Rick, and you don't have to restrict this to metals. Right. Consider potash anything, right? Because we're seeing inflated prices seemingly across the board. I guess for a handful of reasons, including just massive supply chain disruption. Does anything strike you as undervalued and opportunistic right now? Where are you? Are you hunting?
Mid-cap Canadian oil and gas.
Mid-cap Canadian oil and gas. Interesting. Okay.
Arc Resources.
Yeah.
Tourmaline, Birchcliff. Those are pathetically cheap. People dislike them because they got shocked with the oil price decline. They dislike them because their prime minister doesn't like oil. They dislike them because Greta doesn't like oil. All of that's irrelevant. These companies, if we hold $60 oil, and particularly if we hold $2.50 Canadian AECO, we should add Peyto to the list. They are going to be swimming in free cash. By free cash, I don't mean revenue in excess of direct expenditures. I mean revenue in excess of expenditures and sufficient sustaining capital expenditure to maintain their current rates of production. These companies are going to generate very, very, very large free cash margins. And Canada is beginning to discover, as a consequence of the controversy over the Michigan pipeline, that oil and gas is essential for Canada in many regards. In Eastern Canada, they have this thing called winter, and oil and gas are useful there, provided that people don't want to freeze. And it also generates more economic margin than any other activity in Canada. So my suspicion is that you will see the political winds in Canada, while they may not blow in favor of oil and gas, there will be less social hostility towards oil and gas. And the Western Canadian Sedimentary Basin is such a spectacular geological horizon. And the talent and creativity of the Alberta oil and gas community is absolutely world-class. So if I had to pick one place for Canadians to speculate, it would be in their own backyard in a sector that they forgot was world-class.
Fascinating. Okay. I love that. Thank you for that. Thanks for sharing. Anything else come to mind, Rick?
Not immediately to mind.
Okay.
There are, I would say we talked in your last show, the only other broad class of natural resource companies that strike me as being cheap are Russian.
You mentioned
people are afraid of political risk in Russia, as am I. I just think that the fear of political risk in Russia relative to the risk in Canada and the United States means that American and Canadian companies sell at an undue premium and Russian companies sell at an undue discount. Of course, Putin could do one dumb thing and make me look like a complete moron. But I think the probability that Biden does something stupid or Trudeau does something stupid is equally high.
Yeah, I agree with that. Okay. Now, switching gears a little bit, I want to ask your advice on portfolio allocation. And because this has come up on my channel, in my comments under the videos, we often see it, people asking what percent of their portfolio should be in speculations versus assets. And some get more detailed investments versus speculations. My question for you, though, is do you have hard, fast rules, Rick, and how you allocate your cash and your capital?
Yes, I do. But I'm a professional investor and speculator, and I'm at it full time.
Yeah.
A better question for your listeners and readers to ask is, how much they can afford to speculate relative to how much can they afford to invest. I define investment as an outlay of capital made in anticipation of the probable return of an acceptable rate of return. In other words, I think that a successful effort is more likely than not. I define speculation as an activity where you are taking outsized risk in hopes of outsized returns, but where the return profile is possible as opposed to probable. So the first thing a speculator needs to ask himself or herself is how much money are they willing to put up that they could afford to lose half of without changing their decision as to what to have for breakfast. Mm-hmm. That amount of money is the money that you think about speculating with. The second thing, however, that investors need to ask themselves is how much time and effort are they willing to put in place? In other words, it's not a market question. It's a personal question. Mm-hmm. Speculation is hard, and you have to apply yourself to speculation. I ask clients to own, I suggest to clients that the number of speculative stocks that they own should be equal to the number of hours per month that they intend to spend on applied studies of the stocks in their portfolio. And I don't just mean listening to videos. I mean reading annual reports, reading proxies, reading 43 101s. If somebody's willing to spend 10 hours a month, then 10 stocks is fine. Mm-hmm. If somebody's willing to spend 40 hours a month, which is to say they don't have much of a life, then 40 stocks is fine. But too many of your listeners representing the speculative community own way more stocks than they can reasonably follow. And many of them don't remember the reasons why they own the stock at all. So rather than ask in terms of portfolio allocation, ask a question about risk tolerance, first of all, and then time allocation. Those are more important questions.
Yeah, I love that. Thank you. And yeah, I know it speaks to my audience because a lot of them are just like me. They, maybe run a small business, are fully employed, have family life, and invest, right? And it's the and invest. And often when it comes to time allocation, that might be the first thing that gets chopped as priorities become priorities.
Correct. And many people, even if they spend the time in ways that they consider to be more pleasurable than reading 43 101s.
Yeah.
Or annual reports. Many investors consider the time that they spend pondering global macro to be a fundamental with regards to a junior company.
Right.
And that's not true. You need to study information that's specific to the company. The micro is much more important than the macro. Hundreds of times, Jay, people have said to me, if the price of gold were to go up by 50%, what impact would that have on your valuation for Amalgamated Moose Pasture explorations? And I say, Amalgamated Moose Pasture doesn't have any gold. They're looking for gold. And if the price of something that you don't have any of rises, it has no impact on your intrinsic value. It might have an effect on the narrative surrounding the company, which is to say there might be more dumb people attracted to it than are already attracted to it.
Sure.
But that isn't the same as a valuation equation.
Okay. Now, we talked about speculations and investments. Do you have assets in a separate bucket, Rick? And I'm talking about your hard assets, your gold, your real estate, your cash. And does the size of that bucket dictate what's in the investment and speculations bucket?
Sometimes. At present, I'm overweight cash. That's partially because there's too much liquidity in the market. And I believe that there's a possibility of a real market contraction, some sort of black swan event. I'm not saying that the market's going to collapse next week. I'm just saying that valuation levels for all asset classes is approaching levels that I believe is dangerous. And so I feel better owning cash. I understand that cash diminishes my purchasing power, that the interest I get paid is negligible relative to the destruction of value of the cash. But I consider that an options premium. I remember back to 2008 when I had a lot of cash. And that cash gave me the courage and the tools to take advantage of 2008 rather than being taken advantage of by it. Mm-hmm. So I have a lot of cash. Another reason that I have a lot of cash is because the juniors obtained price levels this year that I thought I wouldn't see for 3 or 4 years.
Right.
And I learned that if there isn't very much to buy in the market, that what you do is sell, not buy. And I've been a very aggressive seller of my juniors, and I haven't been able to redeploy the cash. So my cash balances are high. Similarly, on the real estate side of my portfolio, I made some, for me, substantial real estate investments in the early 1990s, particularly for portfolio diversity. I believed that the interest rate would fall, and I believed that my cost of capital would fall, while my rents, my return on capital employed, would increase. What I didn't understand, which is lovely, is that the cap rates would decrease too. That, if you buy something for a 9 cap rate, and your cost of capital falls, and then you can sell it for a 4.5 cap rate, that's a very virtuous set of circumstances. I don't believe that interest rates can fall so much anymore. And so I don't believe that the delta between cost of capital and return on capital employed will grow. And I don't believe in the cap rates that people are paying me for my real estate portfolio. So I'm selling. Whether or not younger people should do that is a different question.
Yeah.
Understand that I assembled this portfolio in the early part of the decade of the 1990s. So this portfolio, like me, is long with tooth.
Sure.
And I'm no longer thinking in 30 or 40 year sequences at 68.
Got it. Okay. Now, are you positioned in Canadian mid-tier oil right now, Rick, or are you shopping around? You are. Okay.
I am. Yeah. I don't work as hard in the sector as I used to. I used to spend more time in oil and gas than I did in mining. And so now, rather than try to gain alpha on the market by buying the $50 million or $100 million names, I do two things. I buy senior secured revolving credit facilities, which is to say that I buy the bank debt of oil companies.
Okay.
And I buy the highest quality mid-tiers that I can find. Highest quality from my viewpoint, defined as the companies that exhibit the best ratio of net present value to enterprise value being market capitalization plus total debt, combined with top tier recycle ratios, which is to say the ability to recycle or reinvest the free cash that they generate into increasing amounts of proved developed producing reserves on the balance sheet. I believe that I'll get enough performance out of the market itself that if I own the best names as opposed to the most leveraged names, my returns will be excellent and my risks will be negligible.
Okay, Rick, it's been great having you back on. I appreciate your perspective and your honesty when it comes to the variety of commodities that we talk about on this show. I know my audience does too, so thanks again for your time.
Always a pleasure. If I may, I'd like to renew my rankings offer to your audience.
Please.
Any of your audience who is interested in this and wants to know what I think about their individual stocks may find out. If you go to a website, sprotusa.com/rankings. Enter your natural resource stocks. I'll rank them 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues where I think my comments might have value. I look forward to doing this. Thousands of people have said it's been educational, and I'd like to say I've learned as much as I've taught. It's been a wonderful process for me.
Awesome. And I highly recommend. There's no downside, and you get Rick's eyes on your portfolio. So foolish thing not to take him up on. Thanks again, Rick. I appreciate it.
Jay, always a pleasure. Say hi to your parents for me.
I will. As always, if you enjoy this content, please hit subscribe. I'd love to have you on the team. And if you want to take the next step and go a bit deeper with my content, I publish a free weekly newsletter every Friday where I debrief my portfolio. I distill the top lessons I've uncovered from the guests I've had on this show every week. And I talk about sectors and industries that I think are poised to move, areas that I'm looking for opportunity, and places that I'm allocating capital. I love writing it. We publish every Friday. The link is right beneath this video. Love to have you join the tribe.